Hey there, welcome to this video all about financial literacy. I know a lot of business people and entrepreneurs who struggle to understand how the moving parts of a company work together to make it a successful one. The solution to that confusion is developing your business and financial acumen and your ability to see the big picture and understand how the business operates and how it makes money and sustain profitable growth. And that's my goal with this training today. Now, I want it to be clear, nothing here is original for me. I obviously didn't invent the profit and loss statement or a balance sheet or the statement of cash flows. And everything in this video is me using all the accounting principles that are just known in the world. And I'm also following the words and lessons from Kevin Kolb's books, training, courses, and all of his other line of work, which I think is brilliant. I'm here in the end of the day just being a student, sharing his words with you, to hopefully help at least one person understand the world of financial literacy, like this content helped me so much in the last few years. So to get the ball rolling, I want to start with some of the questions to ask yourself about a company or a business to know if you understand how the company is. So to start with, the first question you can ask is how much cash was on hand in the end of the year? How much cash was generated from operations? What was the net income? What was the net profit or net income, net earnings, margin? What was the total revenue or total sales? What was the inventory turnover? What was your return on assets? By what percentage did total revenue grow or decline over the previous year? By what percentage did net income grow or decline over the previous year? And how do your results compare to your best years and to your competition? Now, if all those questions are overwhelming you, it's okay. We're going to go through each of those topics as we go. But those are just initial questions to get you intrigued into what we're going to learn today. But ask yourself, when I went through those questions right now, do you even know where to get this information from? Knowing the answers to the information that I just went through, and obviously more, can really help you fix problems, prevent future problems, and take advantage of opportunities to grow in your business, any business that you want to look into, business that you want to buy, business that you want to invest in, or also just point them in businesses that you're working in. Now look, when you break down even the largest, most complex companies out there, you'll find in the end of the day, the same simple drivers that power any business. Those drivers are cash, profit, assets, growth, and people. The first three you can get from the financial statements. Then growth is, of course, important because it's an important objective for shareholders. And the last one is also simple and important because without good people, the other first four just cease to exist. So those 5 key drivers that we're going to go through are the beginning to understand how even the most complicated business can be analyzed and improved. And some of you maybe already heard about these elements in a business, but today we'll go through their full importance in creating success in a business and how they are all connected. Because in the end of the day, you want to be able to communicate about each of them and to remember that the language of business is accounting and finance. And it means numbers. And numbers usually intimidate many people. But if you think of financial statements like you would a health report from your doctor, that you won't be as intimidated because we all want to prevent future potential problems. And look, you don't need to understand every number in a business or how it was calculated, but recognizing a few critical pieces of information, those that reflect the 5 key drivers, will help you understand the health of any company. So let's start with the first one, cash. In the end of the day, the only real unforgivable sin in a business is to run out of cash. Cash is the fuel that drives a business. Without cash, a business can't pay the bills. It can't pay its employees, it can't buy the goods it needs to produce, the products or services that it sells. It can't generate revenue or profit. Without cash, eventually a company will go out of business. And with a reasonable amount of cash on hand, or the ability to easily get more, a company can make it through rough market and economic storms. It can grow by investing in new software or research or equipment. It can take advantage of new market opportunities and can even buy out competitors. If you want it or not, a business must have cash to survive and thrive. And if a company is failing to generate cash because of their mismanagement, when this happens, a lot of them usually just borrow money from a bank or financial institution or investors. So it's very similar to our personal life, and the same goes in business. We all need cash to pay our bills and other obligations. Now, I don't know if you know the stats, but according to the US Small Business Administration, only small percent of small business survive at least 4 years. And one of the primary reasons is basically little cash. If there's no cash in the business, the business won't survive that long. Without cash, a business will fail. So business owners and leaders often find creative ways to get it when times are tough. So now the question is, how do we measure a company's cash and liquidity? So for us to evaluate a company's ability to survive and grow, like even in the most difficult times, we can look at 3 components of cash. So first of all, how much cash does the company currently have available, like immediately right now? This is also called their cash position, the company's cash position. Then, how much cash will it generate and spend through its operations during a given period? This is called cash flow. And number 3, how quickly could it generate more cash by selling different assets? And this is called liquidity. So many like to measure a company's cash position compared to their financial obligations. So basically how much it has versus how much it owes, and what's the company's track record of generating cash flow from operations. Like if you think about it, it's basically the same concerns every one of us should have around our own personal financial situation, right? Like how much we have in the bank and how much we owe every month. And then also like how sure are you that you'll get more cash next month with your job or business? Like all of us need to be aware of those things, and same goes with business. Also, you can add to that, like if you lost your job or other income, like would you be able to keep paying your bills, and then for how long? So again, same way you look at your personal situation, we want to look at businesses and their financials. So I want us to start exploring each of the terms that I just mentioned, and I want to start with what we said and call cash position. So usually when you hear people use the term cash, they are referring to a company's cash position, the amount of cash a business has at any single point, which for public companies, because most of us at least know some public companies, it's reported at the end of a quarter or at the close of its fiscal year. But then the question is like, how is that number calculated? Is that just a lump sum sitting in a bank account somewhere? Well, not really. So the most obvious factor in determining the cash position is what we call actual cash on hand, which includes currency, coin, and also checks in hand. It also includes cash balances in the accounts of all types at different banks and other financial institutions. And then the second part to understand cash that maybe you heard about in the past is what we call cash equivalents, which is basically any short-term securities or other financial instruments, like if a company, like stock market or money market investments that could be owned by a company, all of that could be under cash equivalents as well. Can also be certificates of deposit or short-term like treasury bills that can be sold or converted to cash real quick, usually like within 90 days. So anything within 90 days can be considered also as cash equivalents. It's also important to understand that like you cannot pay bills, right, with money that you don't have yet. So a company's cash position, which we'll get into later on how it looks like on a balance sheet, it doesn't include what we call accounts receivables, which is money owed to a company, right? So accounts receivables is money owed to a company from customers who purchased goods or any services in the past on some kind of a credit. Accounts receivables, they represent cash to be collected in the future, but your cash position is the cash that can be spent right now. Next, let's understand the term cash flow. Maybe you heard the say cash is king, right? Well, here's the thing. It's not only the amount of cash a company has on hand now, but also a company's ability to generate more cash flow in the near future that is as important. So a better way to say, or something that I've heard in the past in the markets, is that cash cows, they are kings. Like if you talk to investors or financial analysts and other company leaders, you'll hear from them that cash flow is the most important indicator of a company's health. It's all about their ability to be successful and make money over the long term that matters here. So cash flow is simply the volume of cash that flows through a business as a result of operations over some kind of a period of time. Now, in cash flow, when we're talking about cash flow, there are two factors of cash flow. So we have cash inflows, which is cash received in the form of sales, revenues, and there's also cash outflows, or basically the expenses of the company, right? So there's cash in, cash out. So what the company is bringing in versus what the company is bringing out, and what the company must pay to perform as a company. So simply put, to understand cash flow is basically cash received less cash paid, right? And that's all part of kind of like the core business operations. And a company can have either a positive cash flow situation, so total cash inflows that are greater than total cash outflows, or what we call a negative cash flow. Like when outflows are greater than inflows, then it's a negative cash flow situation, which probably now help you understand and see why like investors, shareholders, and employees should be super concerned about a company that is consistently paying out more cash than it's bringing, right? And you see it with a lot of fast-growing tech companies that spend a lot of money, and yeah, as long as they have more cash coming in from investments, it's okay. But if that's not the case, you need to be really worried as an investor, shareholder, or an employee in the business. Because a company like that will eventually be unable to pay their bills and will just be forced to declare bankruptcy or just close their doors unless they can raise more and more unlimited cash. That's why you see stories like WeWork that grew like crazy, but cash flow was negative, but they didn't really care because they always were able to raise more capital until they didn't. And then things just went down very fast. They're still a multi-billion-dollar company, a public company, but it's just to show you how things can change really fast when you have a negative cash flow situation. And I also want to add real quick, because we're going to get to that later, but cash flow is not profit. A bit later, we'll look at profit and how it's different than cash flow. Next, let's talk about the next term that is really important to understand, which is liquidity. When we talk about how liquid a company is, we are referring to their cash position plus their ability to generate more cash quickly without much cost by selling its assets. So when you hear liquidation or to liquidate, it basically means to sell assets so you can then turn them into cash. Now, by definition, cash and cash equivalents that we talked about are the most liquid assets. But that doesn't mean that a company that doesn't have a lot of cash on hand is illiquid. You can take a company like Walmart, for example, right? They consistently carry very low balance of cash and cash equivalents on their balance sheet, which again, we'll talk all about balance sheet later, but I want you to understand the basics first. But a company like Walmart is still a very liquid company. Why? Because they also carry large amount of inventory that is just constantly converting into cash. So they have their assets. So they just have super strong ability to generate like substantial cash flow through rapid inventory turnover, right? They buy inventory and they can sell it very, very fast. On the other hand, like if a company didn't have large amount of cash and owned mostly fixed assets, right? Assets like real estate and office buildings that could take months or even years to sell, it would be considered just overall less liquid. Because if that company like couldn't show that it had the ability to generate solid, consistent cash flow, like investors and stockholders will just start to worry. Now, if we want to get a deeper understanding of cash and how a company actually generates it, then we have to look at all the ways a company gets cash and also all the ways a company uses cash, which is what I want us to dive in next. How companies get cash and uses cash. So there are three types of activities that companies participate in to either get cash or use cash. So each of the following activities that we're going to go through, they are basically a source of cash for a company, but also requires to disburse and pay cash. And of course, for any company, the hope is that they just get more cash than they use. So let's start with understanding the first activity that a company does to generate or pay cash, which is what we call operating activities. So when you look at cash generated from companies, like their core business activities, right, less the cash expenses from those activities, is what we call cash flow or cash from operations. Operating activities are obviously the most important source of cash for any business because they are basically the activities that a company engaged in to make money, right? Any company, the reason for them to exist is to engage in some operating activities, right? To sell their service or a different product that they have. So those are all under the category of operating activities. And for every business out there, like that should be ongoing source of cash, right? Like there's no reason for a company to exist unless they can generate cash over time consistently. And all of that is under the operating activities category. And the simple way to understand it is you get cash from sales, from revenues, right? And then you use cash for expenses, right? You have a business expense, you go out there, you spend it, and you try to bring in sales to bring in revenues and sales, right? And then that's how you determine cash flow from operating activities. It's basically revenues minus expenses, and you can find the cash flow from there. And that's assuming that all payments are done right now in cash, right? So it's a clear, a super important thing to pay attention to before we move to some of the other stuff we'll talk about in the future. Now let's talk about the next activity that you'll see from companies to try and generate cash, which is a company's investing activities, right? So if a company is getting bigger, usually they have some money that they use to go out there and invest. So when we think about the category of investing activities, it basically requires a company to use cash to purchase things like equipment or facilities. So think like buying vehicles or computers or warehouses, or can also be real estate or stocks or bonds or any other security and maybe other businesses doing mergers and acquisitions. All of those things can happen if a company just have enough cash, and a lot of them will then go and look for investment activities. And many times you see companies use cash in that way because they believe that they'll be able to either use the assets that they invest in to create more cash flow as part of the core business, or they believe that they can earn interest or dividends or be able to sell the investments for more money over time than it paid for. Now, usually investment activities, like investing activities, they're necessary for most businesses, but they come with a bit of a risk because the return on the investment, basically what's the cash in versus the cash out, it's not a guarantee, right? When you invest in things, nothing is guaranteed to get a return. Like a company can sell an existing assets like a building or equipment to try and generate cash, but maybe that's not sustainable way to get cash, mostly because you won't be able to use that assets anymore, right? So maybe you got cash right now, but can you go out there and produce more cash flow if you just sold that asset? It's like if a carpenter would go out there and sell his tools to try and raise money. So yes, it will give him some cash in the short term, right, under investing activities, but it will reduce his ability to generate more cash in the future. And then over time, you won't have any reason to stay in business. Now let's talk about the next activity that you'll see from companies to generate cash. And we're talking next about financing activities, right? So remember, we have operating, you get cash flow from operations, you get cash flow from investing in things, and then the next one is financing activities. So any company can go out there and get cash through different financing activities, right? So they can go out there and borrow from financial institutions, banks or whatnot, or from also investors, or they can go and sell shares of the existing company's stock. So all of those things are under financing activities to generate cash. Also, a business might also use cash in those different activities by paying back different loans or paying dividends to stockholders or buying back shares of the company's stock. All those also under the same category. So every cash that is received and used in each of those different three areas that we just talked about, all of those are being tracked on a company's statement of cash flows. And in there, you can see sources of cash and where it comes from and how cash is used and where the cash is going, all under the statement of cash flows, right? So again, you'll see in there cash that generated from operations, so the core business activities, right? That's in the end of the day, the best source of cash because like your company doesn't have to sell assets to generate that cash. When you sell assets, remember that's going to a different category. Those are investing activities. Or you can borrow money, which are financing activities, right? So you have operations, investing activities, and financing activities. Everything is under the statement of cash flows, which we'll dive into later, but I think it's very important to start with this so you understand the basics of cash in, cash out, what a company can do with cash, and under each category, which categories they go under, and where can you see them in the end of the day, which is in the statement of cash flow, which we'll dive into later as well. So overall, the formula to determine how much cash has been generated through any of these activities is basically cash in minus cash out, and that equals cash generated. So to keep the amount of cash generated positive, and growing companies want to increase the cash in, of course, at a greater rate, ideally than cash out, because then it means that like they're overall growing. And in the end of the day, companies are interested in generating more cash, even if they already have a strong position in cash flow. At the end of the day, improving operating cash flow is a sign that the company is doing well and should continue to do well, at least in the near term. Like if the operating cash flow is going on and there's no stop coming soon to that, then overall the company is doing pretty well. Now the question is, so what a company is doing to generate more cash, right? Like what are those activities that a company can take to generate more cash? And obviously it will start with operations, right? And so there's some kind of an operation in the business. They try to increase revenues, which is cash in. And every company over time also try to reduce expenses, which is their cash out. From there, assuming that there's some kind of cash in and some kind of cash out, the company will continue to invest in resources or different assets. Like for example, buying 2 new ovens to cook more pizza faster in a pizza shop, for example. Then they can use those ovens, those assets, to go out there and generate more cash flow and sell more pizza, sell more of their product. And maybe, if they want to grow real fast and they need a lot of money and they have like big strategic initiative and thinking, maybe they want to open new stores, then they'll go out there and seek financing, right? If a company want to grow fast, they can go to investors or banks and try to raise more capital so they can move faster and invest in larger assets. Another thing a business can do is obviously collect money from the customers before they build or ship the product. What else? The company can also negotiate with their suppliers to pay them 2 or 3 months later, which will then provide plenty of cash on hand for the company right now. No matter what the strategy is, the goal for any business is to generate as much cash as possible from operations in the end of the day, now and in the future. That's the goal of any business. And of course, hopefully, their services and products provide value. So that's why every company out there will always try to generate more cash by increasing the volume of sales revenues by selling the products or services that they have. Then after they sell to some customers, right, they will also try to get those customers back to continue to buy from the company even more, again and again and again. Those are the best businesses, right? So if you get more customers, you get them consistently, and alongside that, you're trying to get longer payment terms with suppliers, obviously, hopefully without hurting the relationship with them, that's how you can produce more. Another thing a company can do is get customers to pay bills on time or early, right? Or looking for better financing terms on the loans of the company's takes, or just overall cutting down on any waste in the company, right? While trying to get the most out of any assets that the business have. So the business can do things more efficiently, right? So if you have one oven in a pizza store, can you use it 24/7 instead of 12 hours a day to just be more efficient with whatever assets you have? So then how a company decides on when to use cash, right? So we talked about how a company can get and use cash. So knowing the options is obviously great, but how does a company decide what to do and in what order, right? So let's say a company pay for all the operating expenses to run the business, right? And after they pay all expenses, they still have some remaining cash flow, right? They can then use it for investment and financing activities so they can sustain and grow the business even more. That's the goal. And that's how companies get big, right? That's when a company will start to look at providing like higher return on the investments for their stockholders, right? Which are the owners of the business. And that's what they really care about. Like when someone is investing in a business, they want to make sure that that business they're investing in is bringing them a better return on their investments, on their assets compared to other investment opportunities. And that's the goal of every business. And cash, of course, is like any other assets, right? It should be used to produce a return. That's why 2 of the most important roles that the business leaders play are determining how best to generate cash and then deciding how to use the cash wisely and efficiently to generate even more cash flow in the future. That's their role. That's the job. If a company got cash sitting in the bank, they could keep it in the bank and have liquidity, or they can invest in other assets to help the business, or even buy stocks or buy mutual funds that will provide greater return than just keeping the money in a saving account. That's why we've seen a lot of venture capital firms, when they invest in companies, they don't like to see too much cash in the bank, because they're telling them, hey, like, if I'm investing in you, I want to see the money in work. I don't want to see the money sitting in the bank. I can do it on my own. When I invest in a company, I want to see things growing faster. I want to get better return than me putting money in my own bank account and putting and saving it in cash. I can do it on my own as an investor. I don't need to put it in a company's bank account. So that's why when you're investing in a business, you want to see things moving usually, and usually more faster than just putting things in cash, because there's more risk in business. So obviously your return is expected to be higher. So there's always question of what will generate better returns for the business over time and will be the best decision. That's the question here. And that's always on the management of the business to decide. In the end of the day, companies will use the cash they generate from operating activities, from investing activities, and from financing activities for many different business purposes, right? So remember, it's all over the place, and the goal of the management is to produce better returns than any other business opportunities. So a business can use it to pay dividends, like we said, to buy back stock, to invest in mergers and acquisitions, to invest in research and development, and any other capital expenditures like plants, equipment, and real estate. And obviously, the stronger the cash flow is, the more options the business will have to then grow the business. Companies that generate a lot of cash flow can have massive capabilities compared to those with less liquidity and cash flow. It's as simple as that. If your business can generate more cash flow than your competitor, you're gonna make, like, your life is gonna be much easier. You could go out there and invest heavily into all those things that we talked about, right? You can buy and grow by acquisitions of buying the best companies. You can go out there and hire and pay top talent. You could spend more money on marketing and advertising, and that will allow you to bring even more sales and more cash flow. You could have more cash to play with, so you can take risks on new products and ideas and new markets and technologies, right? And those could even fail and nothing will happen. You won't devastate the business. That's when you see companies like Google, they just invest massive amount of money, or Facebook, Meta, that invest massive amounts of billions of dollars every year in the metaverse that is just an idea right now. But they can do that because they have cash flow going from their main operating activities, so they can handle and deal with lots of different tasks of new products and services. All those companies like Apple, Google, Microsoft, they're extremely profitable, and they're basically cash cows that produce tons of cash flow. And the question is, how much cash is enough? So first, a company can never have too much cash flow, right? When it comes to their cash position, that might be a little different. And it's in regards to some of the things that I already mentioned. Let's go through that. But you need to understand that the rule of thumb for how much cash a company should keep on hand is that there's no rule of thumb about how much cash a company should keep on hand. Because every company is different in how much cash they need for operations, and also how much cash they need to protect themselves in case of, like, if there's some kind of financial hit or something happens. And the numbers are different for any business based on their sector, the size, and whatever their operation is. And that's when you see CFOs or CEOs or whoever is in charge of money in a business, that's when they consider different things for that to determine the amount of cash to keep for rainy days. So there's always this constant question of how much cash you need to keep for a rainy day in the business versus how much money you want to reinvest in the company to try and keep it growing. And let's go through some of those things, right? Like what someone should look for to determine this answer. And it started with the seasonality of the company's sales, right? So if a company is mostly selling like year-end decorations, for example, it may need less cash in reserves in November and December. And in November, December, they should have lots of cash flow from sales, right? Then in other months when the cash flow is much lower, then not necessarily. The next thing CEOs, CFOs will look for is kind of like overall the company's growth trend and their forecast to the future. So what they forecast and what the growth in sales they believe will be. And based on that, they can do some kind of a pro forma or have a budget to understand what kind of expenses they'll need for different investing opportunities to grow the business. They should also look into any strategic objectives, right, that might need to generate more cash or might generate a lot of cash. Things like acquisitions, mergers, asset purchases, or any other product development. They'll also want to consider and estimate cash reserves, right? That might be necessary to address different sudden changes in the industry or economy, right? So kind of like have some kind of a rainy day fund. Also, looking at the company's ability to borrow money or being able to raise cash by, like if we want to sell stock, like shares, right? What that looks like, which obviously depends on different things like the company's credit or whatever the current interest rates are or the debt levels right now in the business. And just overall, how easy it is to access capital from lenders and investors with the current market situation. It's also very important to consider in the average time that it takes to turn the company into investments, right? So like R&D or inventory, or how long it takes to turn receivables into cash. So those things are kind of like what's known as the cash conversion cycle, right? So if you look at big retailers, for example, it's not much time at all to convert inventory to cash, while for other companies, it can take a while to sell stuff. And then in the end of the day, companies can be criticized for holding too much cash, right? Like I said, investors want to see return on their money, and business can have too much cash because the business purpose in the end of the day is to produce return on all their assets. And cash sitting in the bank isn't necessarily producing the best return possible. Although right now, they start to pay a bit more. So any business leader, if it's you, if it's a business you're looking into and their CEO or CFOs or whoever's in charge for the money, they have to consider in those different issues when they look at their cash reserves. So they have to consider like what is the rate of return on cash that is sitting in the bank account or mutual fund? What is the opportunity cost of hoarding large sums of cash rather than investing in products, growing new markets, or making like a strategic acquisitions? In other words, like what could have been earned if they use the cash in some alternative investment. And any company, in the end of the day, if they have too much cash, the leaders usually immediately start to look for different ways to reinvest in the business, to try and grow the business, to get better returns. Some shareholders may want the cash to be distributed as dividends, right? Which is basically a payment to investors for each share of stock that they own or used to buy back stock in order to reduce the number of shares outstanding, which would give existing shareholders a greater percentage of earning per share owned, which may also mean an increase in the stock price, right? So you see a lot of companies are out there, instead of distributing a dividend, they just buy their own stock. And then they own more, and usually there's an increase in stock price. While holding on too much cash isn't necessarily a good thing, every now and then a company may choose to do it, right? Perhaps the management has a strategy of conserving cash because they have some kind of a big acquisition in mind, or they want to commit to some kind of a larger project and expanding into something. So that's when they might say, okay, let's keep this cash because we're looking at this acquisition or that acquisition that we know is going to cost us money. Other companies, maybe they just believe the industry or the economy is just headed for a rough time and they just want enough cash reserve to help them with the storm. That's why you see Warren Buffett in hard times is actually the one who's keeping the most amount of cash because he knows it's going to bring opportunities, right? So there's no right or wrong on how much cash makes sense to hold in a business. Obviously, you want enough cash to be able to operate the business, but in addition to that, it's really on a deal-by-deal basis, on a business-by-business basis, and a decision of the key shareholders. As long as you understand that in the end of the day, cash is fuel, right? Without it, the engine of what we call a business can't run. And eventually the business can just slow down and die. It's a matter of time. There's no cash flow, the business will die eventually. So let's do a quick summary of everything cash. Cash is the fuel of business. All companies require cash to operate, pay bills, and invest for the future. Lack of cash is primary reason for businesses to fail. At any point in time, the cash position is known as the amount of cash on hand plus short-term securities that can convert to cash within 90 days, also called cash equivalents. Now, during any period of time, can be month, quarter, year, cash flow is all cash collected from the company's operations, right? Which is basically the core business, what the business is doing, selling products, how it's generating cash flow from the products or services, less all the cash used for expenses to run the business. Now, the ability to generate cash flow is usually considered more important than the amount of overall cash on hand at any given point, right? Like if you have $1 million on hand, but you're not going to be able to generate any more cash in the future, like what's more important? Liquidity, that refers to companies' available cash and their ability to turn their assets into cash quickly and hopefully inexpensively. Overall, remember, a business gets and uses cash in 3 basic activities. So number 1, their operations or core business. That's one way to generate cash. Number 2 is investing or buying or selling assets. Or number 3, financing, right? So by receiving or paying back loans or selling back stock to investors, right? Or paying dividends or buying back their own stock. That's another way to generate cash. You can impact cash by helping to increase revenues, cut costs, delay payables, which is the money that is owed by the company. You can accelerate collection of accounts receivable, so the money that is owed to the company, can you get it faster? A business with too much cash is earning very little return on cash compared to what it might earn through any potential alternative investment or uses. And usually shareholders in a business, they prefer that excess cash to be invested. They want to see money is moving, cash is moving. Otherwise, they just want the money back to do something better with it and get better returns somewhere else. Next, let's talk about profit. So what is profit? Profit is simply the difference between how much you make by selling goods or different services, which is basically known as revenues for a company, and then how much it costs to produce and sell them, which are the expenses. But remember, profit is not the same thing as cash flow, which I'll explain in a second. So obviously you want to sell your products for more than they cost, right? And it's actually amazing to see how many businesses lose track of this super simple idea. In the end of the day, company's future is ultimately determined by how much cash it generates from profits, where that cash comes from, and how fast and consistently it comes in over time. Like for public companies, like their stock price is determined primarily by how quickly, right? By how much and with what consistency investors believe the company will increase their profit. When it comes to profits, it can be earned mostly by the core business operations, but also from different investments and selling assets. And in the end of the day, a company's financial health is measured primarily by how much profitably they can conduct their core business and how well they can do it over time, right? Consistency matters. So can they generate, right, increasing sales, or how well they can control expenses and then grow their income. The difference between sales and expenses. That's their income. Another thing to mention is that when people say profit, they might also use different terms like net income or net profit or just income or earnings or net earnings. All those different terms represent the same thing. So now let's get into what is the difference between profit and cash flow. So while on the surface, it might seem that profit and cash flow are just about the same, they are not. And the differences, they amount to how each of them is calculated differently and when one is basically recorded on the books. And I'll tell you in a second what that means. Now, what I'm saying right now might sound like accounting technicalities, but each of those numbers is super meaningful in a unique way. So it's important to understand the difference. So remember what we discussed already. When it comes to cash flow, it's the difference between actual cash received and actual cash used in the process of doing business. Each day, month, quarter, and year, a company receives a certain amount of cash and also pays out a certain amount of cash, right? Super simple. And like we said, cash flow is very real measure of how a company is doing and whether it will be able to pay their bills tomorrow or next week or next month. Profit, on the other hand, is revenue from the sale of services or products, but it's whether the payment in a cash has been received yet or not. Then you minus all the expenses, and those can be expenses that paid in cash, expenses to be paid in cash later, and expenses accounted for in other ways, right? So that's where the complication is starting to get in a bit. So that's why a lot of people say that profit isn't real, because the cash sometimes hasn't moved in and out of the company yet. But it's still important to know if a company is earning income and making more than it's spending from the daily operations over a period of time. So I hope that makes sense. If there's revenue for the business, it doesn't necessarily mean that we received cash for it. It could be cash that we will receive 20 days from now, when the client is paying his second payment for the product or service. And if we didn't calculate profit that way, like a company could appear to not earn any income one month and be hugely profitable the next month, and so on. And all of it is going to be depending on when they bills clients, or when their bills are due, and when customers paid their debt to the company. So if we can't see, like in the end of the day, it wouldn't be a very good indicator of how consistently the company is earning from like their income from their core operations, right? Because even if the financial performance was steady overall, it might seem unstable if we didn't follow this type of accounting system. And that accounting system is called accrual-based accounting, which all public companies are using. It allows us to see consistency in the operation results of the company. And without it, it would be a bit messy, and we'll see lots of inconsistencies, which will basically won't help us in deciding if we want to be involved in the business or not. Another way to think about it is that accrual-based accounting is that basically tracks transactions, right? So if it's sales, expenses, profits, all of those are recorded when the transaction is made, but not necessarily when all cash is received or paid. So for example, Apple, right? Apple computers, they might record the sale of the computer when the customer picks it up at the store, and also the expense for making the computer at the same time, right? And they'll do that even if the customer arranged to pay it for, let's say, several months, right? With payment plans. And the cost of putting the computer together, maybe it was paid a few months before the sale was ever made. So that's how accrual-based accounting is working. With small companies, a lot of them you see, they're still using cash-based accounting. That's where you record a sale when cash is received and expenses when they are paid right away. And later we'll look at the income statement, and that's where we'll be really able to explore all those different factors that affect the profit calculation. Now, when it comes to understanding profit, there are two common measures that people focus on. So we have gross profit and we have net profit. And each of those measures is an important indicator of financial health. So gross profit it's a useful measure for companies on a day-to-day basis, because it tells them like how much money they are earning on each product or service that they're selling. Gross profit is calculated by subtracting the cost of a particular product or service. So basically, what it costs the company to buy or make specifically that product or delivering of that specific service, also known as cost of goods sold. And it's cost of goods sold from overall the sale price of the product or service. All right, so what are the direct costs to make that specific sale? Also, like more often than that, like we refer to total gross profits, which is all revenue, basically total sales from core operations, less the total cost of goods sold. Now, a company, they want to earn as much as possible from each sale, right? So it will look at the gross profit when they set prices for each of their products. Or they'll decide if or whether to sell a product or a service in the first place. Because if there's not enough profit in there, after the direct cost for the product, it makes no sense to sell it, right? They might also determine like different product mixes that they can offer and decide how much money they should make on each. That's also how companies budget for buying or making a product in the first place or delivering on any service. So when a company, let's say when Apple is creating the AirPods, they want to make sure that they have enough gross profit on every time it costs them to create the product, right? Unless they have enough profit, they can't be profitable as a company. And I'm talking about direct costs to create the product. So what it costs to manufacture the product, for example. Now, when people talk about how profitable a company is, they're usually referring to the amount of net profit that the company earned. And a lot of time you hear people say, hey, this new strategy is going to improve the bottom line. That's when they are talking about net profit. Because net profit is generally the last line, like the bottom line on the income statement, which again we'll expand about later. So net profit is simply all the revenue recorded. So we're starting by selling a product, we're bringing revenues, right? So it's simply all the revenue recorded by the company minus all the expenses, including the cost of goods or services that's sold, and also including expenses that are not related to the sale of a specific good or services. So when we're talking about not specific ones, we're talking about things like salaries, rent, advertising costs, utilities, things like that are not necessarily specific to selling one specific product. And we're talking about those extra costs, we're talking about, they're referred as operating expenses, and we'll also expand on them later. Another operating expenses that is frequently discussed, which is important to know about, is overhead or general and administrative costs, which that's where you include things like salaries or supplies or other similar things like that. But it all starts with the gross profit. Without a strong gross profit, a company can't create any net profit, right? Because the gross profit, the initial profit from selling a specific product, it must be high enough to cover all the other operating expenses. So if the gross profit isn't high enough, then it won't be able to cover all the other operating expenses, which will leave the bottom line, the net profit, not too good. So for both the gross profit and the net profit, people will often focus on the profit margin, which is basically just the amount of profit divided by the amount of revenue. And then we express it as percentage. And that's where you hear people, that's when they mention things like gross profit margin or gross margin or net profit margin. Now, why people care about margins in the first place? It's because they tell us how efficiently a company is turning revenue into profit. And the more efficiently a company is turning revenue into profit and higher percentages of profit, it just means that overall they're performing better as a company. And we might want to be invested or involved in a business like that compared to a competitor that isn't as efficient. So just to get the idea, for example, if the net profit margin is 8%, then 8 cents out of every dollar received is profit in a business. And even though one company has lower profit in dollars than another, their profit margin might be significantly higher, right? Which indicates that it's a well-managed business. And those are businesses that we like, businesses that generate much more profit from every dollar of revenue. Those are the best businesses. If I have $1 of revenue here and more profit compared to a competitor, it's just a better business, period. So let's just do a quick example. Let's say the revenue is $140,000, right? And then let's say cost of goods sold, right? Or also known as COGS. Let's say that's $91,000. All right, so $140,000 minus $91,000, what's left is the gross profit, which is $49,000. After that, let's assume that the line below that, we have all the different operating costs. And let's assume that that's $38,000. So if you reduce all those things, it leaves us with a net profit before tax of $11,000. Let's say you want to add taxes to it, $4,000, right? And those are just assumptions, right? Then what we are left with is a net profit or net income of $7,000, the bottom line. And what I just went through is a simple example of a profit and loss statement, which we'll expand about in the future, but it's good for you to start to understand and hear those terms, are also known as P&L. Right? So on a P&L, like the above, the gross margin is 35%, which comes from $49,000 divided by $140,000. The net margin here is 5%, which comes from $7,000 divided by $140,000, which is the revenue. All right, so net income divided by revenue, giving us the net margin. And again, this is just an example, of course. It's not a big profit margin, and usually companies that sell commodities or products that are just readily available from multiple vendors, they'll typically have lower profit margins. And that's like if you compare it to companies that are selling something unique or exclusive, like Apple, they can charge higher because they have very exclusive products usually. Now, there are two ways to increase profits in a business. And most companies would, of course, like to increase profits, and most investors would like companies to increase profits. Like you see it in companies, it's almost like their primary factor in the company strategy, and many times that's the main focus, right? Especially if profits have been like steady or declining, that's going to be the shareholders and the CEO's like main priority. How can we make it profitable? Unless it's being backed by VCs and maybe just want to grow fast and have unlimited amount of cash. But usually, assuming that it's a sustainable company, they always want to see profits growing. And that's usually a very key focus for a business. So there are two fundamental ways to increase business profits from operations. Right? So you either grow revenues or you reduce expenses. Right? So anything you want to do or want to see in a business that you're investing in or being part of, at the end of the day, the only focus is what can you do to grow revenue or what can you do to reduce expenses. That's how you increase profits, as simple as that. Now, every company, they try to achieve either of those, right? And it can, of course, be difficult to execute. And, you can always have different unexpected results. Otherwise, every business will grow forever and increase profits forever. But obviously, there are unexpected things that can happen in a business, and that's part of being in business. Because in the end of the day, when you try to grow revenue, like it means that you might need to make more investments. And those investments might not necessarily earn a return like in the near future or maybe at all. Like you might try to make an investment in something and you expect it to bring in more revenues and more profits, but sometimes that's not the case. Like, for example, many people say, hey, just if you want to grow your revenue, just raise your prices. Well, maybe not a lot of people are going to buy from you after you're going to increase prices, right? So it can affect lower overall sales and revenues. And when you try to reduce expenses, you need to do some careful analysis and not just cut expenses without thinking. Like, for example, if you cut employee benefits, right, you might lose super valuable employees and you might have greater costs over time to try and hire new people and train them to bring back the profits you had before, right? So the idea of bringing more revenues or cut expenses, it's easier said than done, of course. But it's important to understand overall the higher level idea of this, that there are only two ways to increase profits in a business. You either grow revenue or you reduce expenses, right? And I want us to now, let's expand on growing sales revenues and what are some of the things that companies are doing to get there. So only two ways now to grow revenues. You either increase the price of the product, the goods, the services, or you increase the overall volume of those products and services. So it's price or volume. Like people, many times might be willing to pay higher price for a product, and with it, it's growing the revenues and it's going to increase overall profits, the gross profits, if there is value added to the product through some kind of an extra features. Or maybe there's some kind of a better ongoing support, or if whatever the market demands that can sustain the higher price. Like I said, we need to be careful there, right? So increasing price can also potentially results in just selling few products, right? Fewer products. The customers might not be willing to pay the higher price, and it can affect the business dramatically. So the result can be potentially more gross profit on each product. So you get maybe make more profit on each product you're selling because it's more expensive now with the same cost. But maybe overall, you're just going to have less total gross and net profits for the business. So what's more important, right? Obviously, you want the overall number to be higher in the end of the day. So that moves us to the second thing, which is when a company thinks that they can increase the prices without kind of like hurting the demand, then they'll often work to increase the overall volume, the sales volume through strategic things. So what kind of things? Things like, for example, lowering prices to increase, maybe create more demand for the product, right? Or innovating different products and services to go out there and produce different services or offerings, right? That maybe are more profitable or maybe have higher demands. Maybe those different services, people want them more, right? Those are some of the things that companies might do. Another way or things that a company can do is they can try to improve the quality, right, of the product, or maybe the quality of the customer service, or maybe the quality of the sales team, so they can sell more, right? Or maybe use more aggressive marketing and sales strategies to create more demand for the products. They might go out there and try to open a new location. Maybe they'll bring products that were sold offline into the online space. Maybe they'll try and develop new distribution channels, right, through different relationships with joint ventures or other companies. Maybe they'll develop new customer markets, or maybe expand to different geographic or demographic, or diversify different demographics or geographic. So we need to take all those things into consideration, right? And at the same time, understand that, okay, if we increase price or reduce price or change the quality of the service, like customers at the end of the day can go out there and buy the same or similar products and services from competitors, right? For maybe lower prices or different level of quality. And a lot of it comes down to also just perceived value in the end of the day. And maybe they'll just go for a competitor because they have, extra quality or warranties or guarantees or services or different accessories for the same or higher or lower price. All those things can affect whatever results the business will have. And for example, if we keep prices the same and we're not increasing prices, right? But maybe we improve our advertising and have better marketing, better customer referral or incentives for referrals, or overall better distribution, that might drive more sales. But at the same time, all those initiatives might cost us more, right? To fund all those additional marketing or distribution costs. And there's always the risk that if we spend more, the sales won't necessarily increase enough to make up for all those extra costs, right? And we also need to keep in mind that whenever you sell an extra unit, the cost of goods sold, you need to keep that in mind as well, right? So you want to make sure that when you affect the bottom line, like, is it going to be minimal or not? All those things are to be considered to, again, try to increase revenue and reduce expenses. So it's not enough to just grow revenues if you want to increase profits. Because if expenses are increasing at a faster rate than sales, then you'll reduce profits until you lose money, even though your overall sales revenue are going up. And that's where you hear tons of business people say, hey, we're growing sales, we're growing revenues like crazy, but we're losing money. What's going on here? That's why any strategy to try and grow revenue, it have to be analyzed super carefully, because every change like that can super affect your business, especially if you're a public company. All those changes can make drastic difference in the business. Let's talk a bit more about the second way of increasing profits, right? Which is reducing costs. So reducing costs to try and increase profit often seems like the easiest path, right? Because reducing any type of expense, assuming that the sales volume is still the same, it will result in increased profit. But there are many sources of costs in any business, right? So there may be also lots of opportunities to make cuts without necessarily putting a burden on any one particular area. And that's okay. If you can cut expenses and keep things as efficient, obviously it's the best thing you can do. Easier said than done. Because the reality is that there are only so many costs that a company can control in the short term. Like, for example, a company, they can change the rent agreement, right away if they pay on properties until the leases are up for renewal, right? So those things are not really in control many times. And also, while cutting costs, often sounds like an easy thing for a company to do when they try to be more profitable. Like, you can't do it if it comes at the expense of the customer. If you're hurting the customer while you're trying to cut costs, like, you're going to lose eventually. So companies should do whatever they can to constantly and consistently drive efficiencies and create more innovations to try and control costs and at the same time stay competitive in the market. Now, I want to go through right now understanding that for any business, there are 4 basic categories of expenses or costs. So the first one is cost of goods sold, COGS, known as COGS. We went through it a bit. We'll go through it in details now. Then we have operating expenses. Then we have interest expense. And then we have taxes. So let's expand on each. Let's start with cost of goods sold, COGS. It's also called or known as cost of sales or the direct costs, because it's basically directly associated with the production or sale of a specific individual product, units, or services. So that's where we're talking about costs that include like cost of the raw material, right? The raw labor to manufacture products. It's the cost of products that purchased from the suppliers or from the distributors, right? For example, in a retail business. And COGS, sometimes called variable costs, because the more products sold, the higher these costs become, Right? The total cost are reduces when sales volume declines. So for every company to be profitable, you must at least have COGS that is less than your overall product sales price. Like in the end of the day, you can't lose money on a specific unit and make it up in volume. It's just not going to work, right? Even though you see some companies that try to do that. Like it's simple math, right? If you're selling each unit, each product at a loss, it costs you more to build the product than you're selling it for. Then, if you add a lot of negative numbers, it's not going to give you a positive one in the end of the day. And then to have a positive actual net profit, you must also have enough left over on every sale so you can cover other operating expenses or interest or taxes. Right? So all those things need to be considered. To influence the COGS, one way to influence the COGS is you can negotiate with suppliers. You can reduce crap and you can improve efficiency. So you have less labor costs and overall time that is needed. So yeah, you can focus on trying to reduce the COGS by getting better prices on inventories that you're buying, on inventory product that you're buying, or any raw materials, right? That's always good. And obviously the bigger the business is, the more negotiation power they have to reduce costs on the COGS. But also you need to keep in mind that lowering your COGS too much, who knows, it might result in a lower quality product or service, right? If you go out there and try to renegotiate your cost of goods, but you're having no limits to the quality or no boundaries for the quality of the product, then obviously it's going to affect things. Or it might create things like manufacturing defects or overall fewer upgrades or add-ons, or maybe you want to reduce customer service and support. All those things will affect you in the end of the day. So when you try to overall lower cost too much, it might end up actually costing the company millions of dollars in the lost sales revenues that you can make. Or maybe you'll have recall expenses if the quality suffers enough. So that was cost of goods, right? Expenses. Now I want us to talk about operating expenses next. Operating expenses, they include things like salaries of support functions like IT, HR, finance, also travel, rent, utilities, sales, marketing expenses, research and development. Also the cost of capital allocations for equipment and buildings that you use to run the business. Operating expenses that remain unchanged over the short term, regardless of the volume of product sold. They're also called fixed costs. So when a company goes through some kind of a period of lower sales revenues, then those fixed costs become very worrisome, and leaders of companies have to start making tough decisions many times. Right? If there are higher expenses there, many times that's when you see decisions like laying off companies, laying off employees. But when there's absence of severe financial circumstances, then companies often seek to lower their operating costs without ever considering laying off employees. And that's when they turn to their employees to help them do it. Because everyone in an organization can work and do their best to try to reduce the overall overhead expenses by reducing waste of any kind. So for example, if you're a manager in a business, you potentially could manage and measure and create different metrics in specific cost areas for your company and team to track. And then you can act on, you can be on top of it to try to improve efficiency on things. Like people in HR, they can try and contribute by maybe finding the most effective and most efficient people possible, like the best employees for different positions in the business. Obviously that can save costs. Another example is leaders of companies can, instead of taking private jets, they can fly coach versus business, right? That's another way to save money. Also, let's talk about, when cutting expenses, let's talk about the interest and other expenses that many companies have, right? So I'm talking about expenses like interest on loans, if there's losses on investment transactions, if there are other expenses related to borrowing and investing money, all of those are under the same category. Now, sometimes these expenses, they're one-time events and non-recurring, like for example, some kind of a purchase of or sale of some specific asset, or maybe a lawsuit, or other costs that are not associated with running the daily business. That can be under this category as well. Companies will work hard to avoid some of these expenses, right? Like loss of an investment. No one wants that, right? But expenses in this category are sometimes necessary. especially if a company wants to make like bold moves to grow, right? Like if they want to buy their competitors, there are going to be expenses. Next, there are taxes, right? So one factor that companies have to consider as they work to try and increase profits is that they will also be increasing their taxable income, right? So overall, they'll see more federal, state, and local taxes. That's part of their expenses as well. So cost-cutting measures, they don't necessarily result in a dollar for dollar increase in profit, right? It's very important to understand it. Just as revenues increases don't. So the savings, they are partially offset by the increase in taxes in this situation. But if a company reduces their tax liability directly, then the money they save is increasing the overall profit. So how a company can do that? If they go out and reinvest profits into the development of the business and maybe taking advantage of different tax breaks. And that's why you see lots of companies create different offshore accounts in Ireland or other jurisdictions. And also many companies, in the end of the day, I think all of us would rather use, the money to invest in the company and try to grow it and create perhaps more expenses that reduce the bottom line than pay too much taxes. And that's another reason why companies try to constantly grow and reinvest back, right? So they may sacrifice profit in order to spend money to just further their overall growth strategy. So remember, while reducing expenses can be difficult, it's often also the most efficient way to improve the bottom line, especially if you have consistent revenue that's coming in. And in the end of the day, if a company wants to increase their profits and they want to continue to grow, they also must increase revenues and at the same time try to control their costs as much as possible. So like we said, they're not going to increase revenue too much, but reducing profits because they're not disciplined on their costs. So hopefully that makes sense. Let's do a bit of a summary on profit. Profit is the difference between the revenues that you generate and the expenses that you incur to create them. Profit is measured in dollars on the income statement and is also referred to as earnings or income. Gross profit is revenue less cost of goods sold, COGS, right? Net profit is revenue less all costs, including operating costs, and those known as overhead and all other costs as well. Profit margin can be either gross or net, is the profit as a percentage of revenue, and it's basically profit divided by revenue. That's how you get to your profit margin numbers. And it's calculated for gross or net. Now, investors, how they evaluate companies? They evaluate the worth of companies basically by their potential to consistently increase profits from their core business over time. You increase profits are increased by some kind of combination of trying to grow sales revenues and or reducing overall costs. Now we can increase revenues, the top line, by either raising product prices and or selling more products to the same or to new customers. We can reduce costs by decreasing the cost of goods sold, which are the direct costs, and or reducing operating expenses, which are overhead or general administrative expenses. So that was profit. Now, next let's talk about assets. In the end of the day, everything a company uses to produce revenue is an asset. Whether it's tangible things like cash, buildings, or equipment, or intangible things like patents or copyrights. Assets, in the end of the day, they are the resources that you use to get the results that every business leader is driving for and striving for. Assets support the financial strength of a company. But the big question for companies is how to balance assets, like the asset strength, and also take advantage of opportunities while also surviving like different difficult economic conditions. And that's kind of like what we call asset utilization, right? So to try and generate high return on different investment. So shareholders, like in the end of the day, we want to meet shareholders' objectives to make sure the company is growing. So let's do a deep dive. What are assets and how do we use them? So let's start with the simple way to understand it. So your house, your cash savings, your investments, all of those are assets that you own. Now, even if you not necessarily using them to produce revenues, you do use them to support some kind of a certain standard of living. Maybe you use them to support your own personal situation or needs, or maybe for whatever other different personal growth or opportunities that you have. And same goes with a company. A company, they have assets and they use them, the company uses them to support their growth by trying to produce more revenues and profits. Now, without enough assets or the right combination of assets, a company can't remain in business because usually just can't be profitable. Right? Think about it this way, like you want to sell your inventory or which is your product, for example. So that's an asset that is there to generate revenue. You lease buildings to put your people in there and equipment also to help you to perform the work of the business. Maybe you use transportation assets like airplanes or trucks, right, to help with travel and shipping of products. Those are also assets. You can use assets to pay bills, to make investments, and to buy inventory, materials, and equipment. Your accounts receivables are assets, right? They represent a source of future cash flow with things like if you have written contracts with customers, right? And those will kind of like give you an indication. They'll indicate payments that you as the business can receive in the future. That's an asset. Even business relationships like joint ventures with other companies or different partnering agreements with different key suppliers, they can be considered as assets, even if those specifically are not listed on the balance sheet, which again, we'll talk about later. But they're obviously, they're used to produce revenue, cash flow, and profits for the business. And of course, your people, right? So even that they're not represented on, you don't see people as assets on financial statements, your people, and that's including employees and customers, like are the most important assets that you have as a business. Without them, none of the other assets makes any money. We all know employees and customers, of course, they're super central to make sure that business is successful. So with that intro, next I want to talk about asset strength and liquidity. Like if I ask you right now, how would you answer the question, how strong is your company? So you might think about cash flow or profit to answer that. But if you're speaking to a sophisticated investor, the potential investor or an analyst, for example, they would also be interested in your asset strength. Your company's asset strength, it reflects the ability to meet their financial obligations now and in the future to be able to survive any potential storms and changes in the business, while also taking advantage of different profitable opportunities that you might come across. And the way to do that is by possessing cash and other assets of hopefully greater value than its liabilities, which are debts and future financial obligations. And we'll talk about those later when we discuss balance sheet, so hopefully I'm not overwhelming too much right now. So what is the most important indicator of asset strength? It comes down to liquidity. In the end of the day, the more liquid the business is, the more cash it has available. Like remember we talked about cash position? So cash and the ability to generate cash is perhaps the most important thing for a company. So anything that impacts cash positively, it makes you stronger as a business. And here we're talking about things like increasing product prices, decreasing costs, maybe selling more products or introducing more products. All of those can improve your company's cash position and strengthen your asset base and liquidity. With more cash, the company can acquire many different types of assets, including other businesses to make more money. Now, because liquidity or what we call asset strength is so important, it's also like we're going to examine it right now from different angles. So what you want to do overall when you start to think about a business is you want to look at the overall value of the assets, and then you want to subtract the total amount of liabilities. I'm talking different financial obligations like debt, to then see what's left over. And hopefully the number is positive. And after we do that subtraction, what we're left with is called equity. And think about just like the equity in your home, if you bought a home, which is basically its market value, kind of like minus what you owe on your mortgage if you have a mortgage. That basically represents a reserve for passively raising cash, right? So if you have equity in your house, you can potentially refinance it and access cash. Then you also see a lot of analysts that might also look at equity as part of some kind of a ratio. And, kind of like they'll compare it to the overall total debt, which called the debt to equity ratio. And we'll discuss that a bit later. But just start to think about, okay, you own a house, you have a mortgage on the house, so some kind of debt, right? You have the overall value of the house, and the difference is your equity. The same goes in business. You have assets, liabilities, and the difference in between. Another thing that is important to look at is the company's ability to cover its debts in the short term. So it's very common to compare cash and other different liquid assets to bills that have to be paid in the next 12 months, which are also called short-term liabilities. If it's something for the next 12 months, it's defined as short-term in the accounting world. So that's why when you're talking about strong companies, like stronger companies can pay their bills and still have lots of liquid assets left over. At the same time, if you have just enough liquid assets on hand to cover yourself for 12 months, then your asset strength may be a bit shaky. Because what happens if your revenue suddenly drops as a business, or maybe there's a big customer that delays paying to you, then you may just find yourself in trouble, right, to overall make payments. Or at the same time, if there's some like massive opportunity for growth, maybe it comes up, you may not be able to even take advantage of it. At the same time, there are some strong companies that have lower level of liquid assets, right, in relationship to short-term liabilities, but they generate such massive and steady cash flow that there's just no concern about the company's ability to meet their obligations. And finally, the nature of the company's assets, especially assets used to generate revenue versus those that aren't used to generate revenues, very much influence the asset strength as well. So to give you an example, like if you have like large amount of real estate for office space or maybe other fixed assets that are not used to produce revenue, then when you have those assets, they obviously provide less financial strength than if you have the same dollar value in assets that are directly used to produce revenue. So overall understanding asset strength and different information and other information that we'll go through later can really help you assess the risk to you as a potential investor or a potential business of yours, even looking at the numbers. And the more equity a company has, the less risky it is, because it have the option, it has the resources to then fall back in case of like troubled times. So look, we said that liquidity is very important aspect, especially of anything asset strength, right? At the same time, cash, for example, like we said, it doesn't necessarily earn a great return, right? Which brings us back to the dilemma mentioned before, like how to balance liquidity and utilization. And that's what we're going to talk about right now. So asset utilization, which is basically all about the productivity of your assets. Like companies that accumulate assets, especially liquid assets, can be an important necessary strategy for some companies. But the purpose of those assets, in general, purpose of assets, even cash, isn't to be locked away. The purpose of assets is to be put to use so it can generate more revenue, right? So it can get some more return on the assets. Otherwise, why we even have assets in the first place? Like we want to see some kind of returns. Again, in a business, we're expecting to get good returns. And with cash, for example, like we said, right, it doesn't earn very high return. So utilizing cash to acquire other assets can potentially earn higher return. But then, again, there's no black or white situation here. It's tricky, right? Because then it also means that there's less flexibility in trying to meet potential problems that might come or going on different opportunities that we might have as a business that usually just require cash right away that you can use. So when you hear people in companies discuss asset utilization, they mean basically how effectively and efficiently you use your assets to produce revenue or to reduce costs. And the biggest factor in asset utilization is productivity, which is basically the amount of work that is accomplished or the goods that is produced per specific unit of asset that is used in this case. And we're talking about, that's including things like equipment, time, labor, people, or cash, right? So what's the overall efficiency and productivity of those assets? Like, to give you an example, a machine, for example, let's say if it's making 100 widgets per day, it's way more productive and is being much better utilized than, let's say, a smaller widget machine that may be making just 50 per day, right? So that's what we call different asset utilization. And this example is basically the case of underutilization of an asset. So when you look at a company, in the end of the day, it's all about finding and reducing or overall completely eliminating those assets that are underperforming. And then we want to constantly replace them with some more efficient assets that can produce more. And at the same time, whenever we have existing assets, we always want to find ways to use those existing assets in a way that is more efficient. So a company should always find different creative ways to constantly try and maximize their asset productivity. Now, in the end of the day, like, measuring productivity for assets is easier said than done, right? Some would say it's a bit of a science because there are many different types of assets and you need different types of ways to measure to determine how productive an asset is or not. Like, for example, how do you measure productivity of a marketing employee? Like, it's going to be very different from how you measure productivity of a widget machine that we mentioned. And don't get me wrong, at the end of the day, there are some universal financial measures, right? So many companies need to understand in the fine details, like how productive each asset is to make sure that they're investing wisely and to make sure that they're using each asset to be able to maximize their return on their investments. So let's go through some of them. Let's start with looking at employee productivity. So the productivity of employees, it obviously reflects how much work employees can accomplish, and we measure it by specific tasks that is being accomplished or not in an hour or in a day, in a week, or whatever is agreed on. So just to give an example, let's say you have a call center and you have an employee there, right? So it's a question of, like, this call center employee, how properly is handling those calls. Like, let's say he's taking 12 calls per hour. It's obviously going to be more productive than someone who's handling only 8 calls per hour, right? And obviously that's assuming that they have, like, the same effectiveness. At the same time, if we have to pay higher performing employee, let's say if we need to pay them twice as much to produce only 50% more, then at this point, maybe the lesser performing employee makes more sense, right? Because the company might not be better off at this point. Like, if the more productive employee, if he's rushing through his calls, if customers are dissatisfied after his calls, then the employee isn't actually more productive in the big picture, right? It's just sabotaging the business. So overall, a company is going to have different ways to determine the productivity of their workforce. And all of it is going to be depending on just the overall nature of the business and the industry and whatever specific functions the individual workers need to perform. Like, one of the key measures that is the easiest to measure is how revenue is produced, or what's the total dollar value of goods or services that are sold, and then divided by the total number of employees. That's where you can quickly see total revenue per employee. And if you are in a similar business that sells similar products or service, and one business have much higher revenue per employee than the other one, then obviously this one is more efficient, the one with higher revenue per employee. So there's a lot of nuances. In some companies, you'll see employees that need to track their time on every project they're working on. Like, you see it a lot in, like, different service companies, like law firm, advertising agencies, maybe accounting firms as well, design firms. So they track everything, right? Because they want to make sure that they're being paid for the assets that they utilize in performing their work. So they track their hourly, and a lot of them are paying or charge per hour. The clients are then billed for every hour worked by any of the employees on their projects. And then it's a matter of us asking, okay, cool, so what people are doing, what is possible to do to improve efficiency in a company by people? So one way to assess the efficiency or the efficiently assets and how they're used to achieve those specific goals, it's, kind of like thinking about completing a project or making a sale or creating a product. And what we can check and measure in this case are things like cycle time. So think about cycle time kind of like as what's the overall time that it takes to complete whatever activity or process, right? So starting to think and compare what's the cycle time for this person compared to that person. Obviously, that's assuming that it's on the same project or activity. So whatever the cycle time of whatever process in a business, if it can be reduced, then obviously productivity is increased. Time is saved for other users, costs are saved if you reduce the overall cycle. And people and other assets are just overall better utilized, right? So the overall utilization of these assets is better. So that's why you see a lot of businesses always try to take their best employee and just try to model and mimic his behaviors. So there's overall process improvement. I think McDonald's is probably known as kind of like the best at it, right? Kind of like the innovator in finding a way to standardize the best efficient processes that now pretty much became the fast food industry norms. Because like, it doesn't matter where you go in the world, you'll find that a Big Mac, for example, and the process for making it and serving it are virtually the same in every country. And it's beautiful to see that. They utilize their assets very efficiently. So overall, this business process improvement, it's key to help people and overall other assets just perform more productively. And every successful company, you see that they always work with the team to find, identify, and overall streamline those processes, especially in the process of making and trying to implement decisions. Next important is understanding like inventory, for example, is also like super important asset, right? And especially important one for like retail businesses. So the productivity or utilization of inventory is how it's measured. It's measured by inventory turnover, or basically what's the numbers of time that a company sells through their average inventory in 1 year, right? So that's kind of like when you hear about inventory turnover, that's what we're talking about, right? So what's the numbers of times that a company sell through their inventory in a year? So let's say a retail stores, let's say they have average inventory worth $100,000 in retail sales value. And if their annual revenues are $1 million, then the way to calculate it is that they sell their inventory on average 10 times per year. And in this case, the inventory turnover, so now if you want to compare it, let's say there's a competitor that have, let's say similar inventory, right? So let's say the competitor also got $100,000 in inventory, but their inventory turnover is 20. So it means that the competitor, he sells twice the volume of the inventory and he basically makes twice the amount of revenue. So 2 million. And this point also twice the total gross profit. So you see how inventory turnover play here and how this business compared to this one, how this one is utilizing things better and faster. Another way, by the way, it's good to know that if you want to calculate inventory turnover is to take cost of goods sold and divide it by the inventory. That's this easy way to do that. So overall, determining the productivity of a specific asset is super important to make day-to-day management decisions. And also overall strategic decisions, because it helps to understand if like someone needs to take on more debt or maybe improve their cash position. And all of those things are being affected by understanding the overall company's asset utilization. So asset utilization is basically, or how we measure it is, and how you understand it is, what's the return on our assets, right? Or overall, the way to measure it is your profit divided by the total assets. That of course you can find those numbers on the balance sheet, which we'll get to later. But it's good to understand and important to understand the concept right now of asset utilization and eventually comparing things between similar companies in similar sectors and seeing where the numbers are better, what company is more efficient with utilizing their assets. So those measures are some of the tools that people use to make decisions in a business, right? In how they balance asset strength alongside asset utilization. Now let's talk about making decisions when it comes to asset strength and asset utilization. So let's go with an example. Let's say you have $100,000 in cash that you inherited, right? So now the question is, okay, cool. What can you do with the money, hopefully if you want to be financially secure and maybe you also want to earn an income from that. So you have options, right? You could put all of it in some kind of a money market fund. Let's say you get 2% from it. And in this case, you have maximum liquidity because you could sell it at any point and financial strength. Or what you can do is you might use all that cash to go out there and buy some kind of a small property, right? And just for assumption, let's say that you have no mortgage, just to keep the numbers simple, right? So you don't have a mortgage or monthly payments. You just buy a property. And then, of course, what you can do, let's say you rent it out. Okay, so let's say you rent it out because you wanted the income. You have very low ongoing costs and you have, let's say, 5 to 10% return. So in this case, just to understand the concepts we talked about so far, is you would have higher utilization because you'll have higher return, ongoing return on your assets, but you won't have any cash left over, right? Assuming that you invested all that money there. So in this case, you have little financial strength and you have no liquidity. I hope those different terms start to make sense right now. At the same time, you could say you also have a third option, right? One that is maybe more balanced. So what you can do is you can potentially balance your need for both strength, which is liquidity and utilization, and right, which is, let's say, focus on return, but put in, let's say, just $50,000 into a market fund and using the other $50,000 as a 50% down payment to buy a $100,000 property. Let's say we keep the numbers same. So even that now, maybe you took a mortgage, but you'd still receive some kind of a good return on renting the property. But at the same time, you still have this smaller, modest return from the $50,000 that you invested in a money market fund, in the low return one. And here's liquid. And with this third example, what we just did is basically, we kind of like got both worlds, right? That's how you get both kind of like asset strength and utilization. And again, it's just a decision of what do you think is better. So in a similar way, kind of like what we mentioned right now on a personal level, in a similar way, any business needs to balance the amount of low yielding cash, right? So what they do to retain their liquidity, but also having the need to put cash into work by investing in potentially higher risk, but higher reward opportunities. But those higher yield opportunities, they might be also super illiquid, right? Like if you see companies going out there and trying to buy other businesses or invest in production plants or purchase capital equipment or borrow more money at a lower interest to invest, right? The proceeds at potentially higher yield opportunities. All those things are being done to increase the utilization. But if a business is only doing that, right, their financial strength, their liquidity, and overall their ratio of debt to assets, right, of the company is going to be reduced. So that's the decision that a CEO always needs to make, right? Like looking at investment opportunities and thinking about how it needs to be balanced with the need for liquidity for the business. So let's just quickly summarize this, understanding maximum asset strength versus maximum utilization. It's a very important concept in business to understand. In the end of the day, we always have opportunity cost and we always need to make decisions. So if we're talking about maximum strengths, then we talk about all cash position, like maximum liquidity, minimum investment in other assets like building equipment, plants, inventories, or other businesses, right? So little or no debt at all. It means that we have excellent strength to meet any obligations and overcome any potential difficulties. But we also have very little existing return on cash assets. And we have minimum to no investment for potentially future returns or company growth. And the other side is when we talk about maximum utilization of assets, we talk about like low cash levels and cash equivalents, because like we said, cash earn usually minimum returns. When we're talking about utilizing everything, we're talking about taking high debt levels compared to equity. We talk about assets that are mostly inventories, fixed assets, and different business units that can earn high returns, right? That's where we want to move things faster, get high returns, and basically do whatever we can to create maximum income and make the most out of our assets, right? And take whatever debt is needed to fuel that growth. And at the same time, it's resulting in less abilities to overcome whatever problems we might have, right? Because those new problems might require cash that we don't have because we use most of the cash. So to find this balance between those two, every business person involved in this type of decisions, they must understand how to assess the return on the investment that is potentially expected when they try to use cash or loans to get access to that asset. And it's easier said than done. And then the question comes is, and again, it can be for your business or a business you're looking into, to invest and see, okay, how this CEO is handling the balance between the two. And then the question is, okay, so how do we analyze opportunities for balancing between strength and utilization? And in the end of the day, the decision all comes down to return on investment. Every decision, everything in business comes down to making decisions. And many decisions, they ultimately going to require some kind of spending, right? Some kind of investment of money or capital. So how do business people determine if they need to spend money to acquire a specific asset? And usually the answer is whatever decision they think will give them a greater return on investment, also known as ROI, right? So the question is always, what will bring better ROI than the alternatives out there that are being considered? So what you'll see CEOs and analysts and investors and people involved in making those decisions in the business, it all comes down to calculating potential ROI per specific project. And those could help with trying to find the right balance that we're looking for. Because any investment in assets, and it can be buildings, manufacturing, plants, like large equipment, machinery, vehicles, all of those in the end of the day should produce some kind of an income stream or contribute to overall the production of the revenues. And at the minimum, like you wanted to generate a return that is bigger than the interest that was paid on the loan to potentially that you took to buy the assets. Or maybe the interest that could have been earned if you just kept that cash. So typically the income or the profit that is produced by any asset is then what you do is you divide it by the cost. And that's where you find the ROI for that asset. And of course, those are all assumptions. No one have a crystal ball on the ROI, but you have some kind of assumptions that you're taking. And also ROI can be measured in many ways, right? So retail sales companies, they might measure like annual sales per square foot on their stores, right? So everything is different. And in the end of the day, calculating different ROIs, it all comes down to what we call cost benefit analysis, which is another term that I'm throwing at you. So to do this type of analysis, first what you want to do is you want to determine kind of like what's the cost for the opportunity or the investment to be made. And then what you want to do is kind of like assess the benefit that you can potentially gain from it, especially like how much revenue or like how much product value you can create from this. Then what you do is you take the potential benefit, right, and you divide it by the cost. That's how you calculate the percentage return on an investment. So in short, just to not overwhelm here, you take the return or the potential benefit, you divide it by the investment or cost, which would give you the approximate ROI percentages. So overall, finding the benefits of different alternative options and doing some kind of ROI analysis, right? So I want to see, okay, what's the ROI on this opportunity versus this? It's super important to understand when it comes to anything business acumen and financials. Because when you're able to do this analysis, you then can compare like apples to apples, when you consider different options. When you do ROI analysis, it can also help with it can also be included things like you can also do some kind of a risk assessment in there. Right? Like in general, if it's a riskier investment, it should require the option, the opportunity to get a higher return than if it's a safer investment. And then the potential for higher return, it's compensated for taking a greater risk. So for example, if some kind of an opportunity is relatively safe and can get you, let's say, 12% ROI, and the alternative is, let's say, super risky, but will get you 15%, then the 12% option could be better choice because it's more safe. And maybe you don't want to take the risk for just that 3% extra. Like the increased risk may not be worth it, just to get a little bit more return. Like, yeah, you might want to consider a riskier asset investment, and you might take it more seriously if, let's say, the possible ROI is 50% or 80% or 200%, then maybe the risk is worth it. So if you're in a position to buy assets, to make recommendations, to, if it's all about, like, let's say you help with the process of purchasing office equipment, real estate or technology, or making whatever other capital investments or helping with hiring people, you always want to evaluate ROI. Always. Because in the end of the day, if assets are not producing good returns, you should sell them. They should be sold to increase cash reserves or to be invested in different and other assets that might generate greater profits and cash. And that's why you see a lot of time companies that, let's say, sell fixed assets like land or buildings to then invest the money in income producing assets and opportunities like different product lines or equipment. Some companies, you also see what they do is they sell the office building and then they list them back because they know, okay, the cash that we can get, the return that we can get on the cash that we freed up can be greater than the cost of the lease. But in the end of the day, all those different analysis, all the analysis in the world doesn't matter if the company isn't keeping an eye for more opportunities to produce greater return on their assets and doing whatever they can to use those assets to grow. That's what a business is all about. And some of the greatest companies in the world, they're so great because they choose to go and reach behind their competitors and invest in assets, right? So like we said, tons of big companies invest a lot of money in research and development or other assets because they know that that would potentially help them grow in the future, right? It could help them access new markets, help them create new products, or help them solve a new problem in the market. So hopefully this section about assets wasn't too overwhelming. Let's do a quick summary on that. So assets, they include anything of value, tangible, intangible, that can basically be used to produce and generate revenues and profits, or that can be converted to cash. Now, even though they're not on the balance sheet, employees, customers are probably the most important asset for any business. Next is remembering that there's a constant challenge of balancing asset strength and asset utilization, right? And figuring out what can produce the maximum return on investment and what can ensure growth and profitability. Remember that asset strength or financial strength, it's measured by the amount and nature of the asset. So basically liquid or illiquid, productive or unproductive. Asset strength affects the overall capability of a company to pay its bills or meet its financial obligations, help with overcoming difficulties, take advantage of opportunities, and just overall generate more cash flow and profit. Liquidity refers to how easily and rapidly your assets can be turned into cash. More liquid companies, they have greater ability to move quickly, to solve problems and take advantage of market opportunities. Employees, they can impact asset strength by doing anything that benefit the cash position. Asset utilization is the measure of how productively your assets are working to make money to drive more sales and profits. Next is remembering that the productivity of employees reflects how much work employees can accomplish and is often affected by the tools and technology they have. And also, of course, the training and the education that they receive. Next is remembering that inventory turnover, it measures how many times a year you sell through your average inventory. Next is remembering that return on assets is a measure of how efficiently and productively a company uses its assets. Also remember that employees can improve asset utilization by eliminating inefficient or non-productive assets or non-producing assets, and just getting more productivity from existing assets and making business processes more efficient, and overall just working to use their personal time more and more efficiently. Also, remember that leaders in a business, they're going to work very hard to try and balance asset strength and utilization. And they're going to do it by constantly, carefully look and assess all those different opportunities that they have, and constantly using return on investment, right? So ROI, and different forms to check and analyze cost and do cost benefit analysis. And finally, remember that the vision for the business, the forecasts and budget for the business, the industry, the services and products, the amount of employees, all those things, overall the economy, all of those things will affect different decisions around assets. Next, we're going to talk about growth. If you look at the biggest companies in the world, right? Look at companies like Amazon. One of the biggest, most deliberate strategic decision Jeff Bezos made is to reinvest cash in the business to push growth. Now, it might be very common right now to see fast-growing companies doing that, but it wasn't back then. Like, if you look at the first year of operations for Amazon, 1996, Amazon generated back then 15.7 million in sales. It was 8 times that number the following year. By the end of 1999, revenues were at $1.6 billion. At the same time, the company wasn't profitable until 2003. Bezos' strategy was to get big fast by gaining market share, by building brand equity, and worrying about profits later. And it's paid off, obviously. Maybe you heard about this phrase, grow or die. That basically reflects the reality of the business world. Because in the end of the day, if a company isn't growing, if they're not expanding and creating a better product constantly and service lines, if they're not constantly going out there and trying to find new customers and markets, if they're not increasing financial strength and ability to attract new capital for further growth, then the competitors will outcompete you by doing all of those. They will take your customers, they will take your market share, and that can just set the company on a downward spiral that can be very hard to escape. Now, don't get me wrong, not every business needs to grow at the level of Amazon, but without some kind of growth, most businesses can't survive. Now, why that's the case? Because constant change is actually the only constant in today's business environment. And growth is one of the only ways to handle it. Change forces a company to adapt to new competition, to anticipate evolving customer needs, and to look for new opportunities. It forces a company to grow. And in the end of the day, companies that seek status quo, they will see change as threatening. While companies that have growth mindset will always look for the right opportunities. And those opportunities can bring good change. Now look, in the end of the day, investors that invest in companies, they expect growth. Employees that are working in a business, they are energized by growth. Customers, they're attracted to companies that are growing. And executives, they're measured, they're getting paid by growth. So why focus on growth? If you ever worked for a successful, profitable, high growth company, think about what was that like. Exciting, most likely, I bet it was exciting. People were energized, they saw new opportunities to be involved in interesting projects. Career path, they opened up as the company expanded their operations, their products, their markets. Talented people joined the organization, right? They're offering stimulating perspectives and innovating ideas. Productivity most likely increased. Bonuses were handed out. Salaries were competitive. Morale was high most likely. But for companies that aren't growing, the picture is very different. If a company isn't adapting to changes in their environment by offering greater value, better prices, or innovative products, your customers, they'll turn to competitors that are more aggressive. And the company, it begins to lose market share, and the best people will leave eventually. Then you see sales plateau usually, and then decrease. Margins and profitability decrease and shrink. Stock price usually drops, and shareholders are disappointed. When that happens, cost cutting increases, right? People are let go, morale decreases, overall productivity and quality of service goes down. Then you see more competitors or more customers goes to competitors, and the company loses more market share. Stock price drops even more, sales decrease even more, profitability shrink even more, and what you get is just a bad, sad picture. So those two different scenarios I just went through, I mean, they should really explain why growth should perhaps be the CEO's number one priority in a business. And if you think about it, like long-term, sustainable, profitable growth is pretty much the primary objective of any CEO of a publicly held company who wants to keep his or her job. Now, yeah, there may be some like small mom and pop operations that continue year after year about the same level of sales and profitability, but any larger or companies that are trying to, or any publicly held enterprise that doesn't grow their sales and profits, they just risk this downward decline and potentially dying as a company. If you look at public companies, the CEO is focused on growth because people that buy the company's stock, in the end of the day, they hope that the share price will rise or a lot of dividends will be paid over time. And the shareholders, the stockholders, they elect the board of directors of a company to oversee their investment. And then the board of directors, they hire a CEO to make sure that it successfully run the company, to make sure that the stock price is going up over time. And yes, the CEO, he can't really control the price of a company's stock in the investment market, but the surest way any CEO can influence a company's stock price is to build a growth company, or basically to increase revenues and profits year after year. So now the question is, cool, so how do we measure growth in a company? And what it comes down is growth in the top line and bottom line. So what that means. If you think about it, a company measures their growth in many ways, right? So it can be increasing number of employees, market share, number of offices, number of states or countries that they serve at, number of customers, amount of assets, and so on. So when we speak of a company's growth, we are usually referring to the top line revenue growth and the bottom line profit growth. Top line, it refers to the first line on the income statement. So that's the revenue. We mentioned that. We're going to go through the P&L later. But for now, I want you to understand the concepts. So we'll always want to ask, when we're looking at a company or our company, we'll always want to ask, by what percentage did a company revenue grow this year compared to last year? Or how much did they grow in one quarter this year compared to the other one? Or to the same quarter last year, let's say. The bottom line is the company's net income or profit, and you'll see it in the P&L, you'll see it in the last line of the income statement. Now, the increase in percentage of rate of growth of both revenue and profit is kind of like a widely used criteria for evaluating the worth and stock price of any company. And remember that a business can grow their top line revenue but have the bottom line profit decline. We mentioned that a bit before, but how is that possible? Because let's say the cost increase at a faster rate than the increase in sales, and that's the situation. So while it might seem obvious that a company should grow their sales like faster and faster than its cost, it's not always easy to do that. Because companies that try to grow have to take risks. They have to make decisions about investments in the future. And if they misjudge like future growth opportunity, or if competitors, let's say they undercut their prices and take away and steal customers, or if the company takes some unexpected downturn that can happen, right? Companies can find their cost increasing faster than sales. Also, some growth strategies, they require leaders to reinvest potential profits into the company again and again and again, kind of like what Amazon did for years. For many companies, let's say declining in profits or lack of profits in the short term might not be an issue. But over time, the bottom line is overall more important than just revenue growth. So that's why you see public companies, they look closely at growth in earnings or profit and at what we call earnings per share. EPS in short. So public companies see that as critical measures of growth, especially for a company that is already matured. Because they've realized that if a company's total assets continually exceed their total revenues, it will ultimately be unable to borrow or raise capital to finance their deficits. And eventually, a company with a shrinking bottom line, no matter what the top line looks like, it will be forced to bankruptcy or just go out of business because they can only keep for so long. Now, to understand it, I want us to talk a bit about organic and inorganic growth. When you look at companies, they grow revenues and profits in two ways. Organically, which also known as internal growth, or inorganically, also known as growth through mergers and acquisitions. You'll see some businesses that adopt or focus more on one approach over the other. Other companies might use combination of the two. And neither model is right or wrong, but both have benefits and drawbacks. Like a business growth organically or from inside when they hire and train new employees, they open new office or stores, they build new plants to produce more goods or to try and serve different customers. They expand their marketing initiatives and their sales initiatives. They go into different geographic locations or demographics, or they introduce maybe new products and services that can be developed by the existing workforce. So when it comes to organic growth, it offers, call it maximum control over kind of like the timing of the expansion and the nature of the operations. There is also generally less risks because management control most aspects around it. And the company, usually that's how they're expanding into business arenas that usually they already understand. So when you look at companies, every person in the company, they can and they hopefully contribute to the organic growth by helping increasing revenues, by helping increasing profits. And that's assuming that there's better, more efficient focus on things like sales, marketing, product, brand management, strategic planning, or retail and store management. And also, of course, functions like HR, IT, finance, all of those can, of course, also contribute organically to a business. With organic growth, the business also spend 100% of the cost expansion and the operation, which can be significant. In the organic growth situation, the management team, they must be on top of every aspect of if there's new offices, stores, or plans, or oversee kind of like all the hiring and training of the new people, and none of them is obviously easy. And of course, it's just important to understand that organic growth can also be very slow, right? Because it takes time to like go into new territories or try to sell to different customers or to generate more revenues than before, or to get new people hired and to train them to become fully trained and productive. And that's why you see a lot of companies that try to grow revenue faster. Many companies, what they do is they also go and buy companies or merge with existing businesses. And that's what we call inorganic growth. So this inorganic growth or external growth is usually faster than organic growth because basically existing customers and revenue streams, you just go out there and acquire them immediately, right away. You just buy a company and you get yourself additional revenues. Also, when you buy companies, you have management teams, employees, production plants, offices, salespeople, and basically any other company assets you can think of, they're already in place. You have product brands and distribution channels. All those are already established from day one of closing on the deal. And yeah, like anything in life, of course, inorganic growth, external growth got its own challenges, right? Obviously, it takes substantial capital to acquire another business. And then after there's an acquisition, there's an objective of trying to reduce cost by combining those operations of those two businesses. Let's say I bought a company, I want to combine operations, right? So it's rarely happen like seamlessly. There's always challenges involved. You see a lot of times employees that might be terminated or undermining morale and productivity. Information and technology systems might be like incompatible when there's mergers and acquisition, which means that there's more cash and investment that is needed that usually will just cause more delays. Not even to talk about merging organizational cultures that can be unanticipated, right? And can be resistance when it comes to trying to grow externally or inorganically. Next, let's do a bit of a deep dive to understand the life cycle of a business. So the classic stages in a business is usually there's startup, then growth, then maturity, then usually some kind of a decline at some point. Those are kind of the classic stages of business life. And it's useful way to think about how a company develops and grows, but it's also a bit misleading because having one stage labeled growth means that the company isn't growing in other stages. So of course it is until there's a decline. And while we use the term life cycle, businesses like rarely progress from one stage to another in like a step-by-step fashion. Like a company might move back and forth between growth and maturity. Like when there's new markets or technologies, when they become available, things can happen and change in the business as well. Or if there's a new division within a mature company, maybe like that might exhibit all behavioral of a startup. But still, it's just important to understand that the growth of a company changes over time, if you want it or not. And just using those stages of the life cycle, it just help us to anticipate kind of like what type of growth we might expect in a company or not. So for example, a startup, it might struggle along for a while, like with a little growth, and maybe kind of like just do enough to keep it alive as they try to attract more customers or clients. But then something might hit and they take off, right? And this is kind of like the growth stage. And it can take a company from being a small operation or company to becoming a global organization when that happens. And then growth is very high and fast in this period. But that growth, if it's too rapid, can also be unsustainable. Because if a business is growing too fast, like if there's an increase in size and complexity, as you grow, there's just more complexity over time. And that's why you see fast growing companies that eventually enter into maturity and having a growth that is more steady and sustainable. And of course, all of it is really depends and determined also by the industry and the overall situation in the economy. Now, don't get me wrong. Of course, all of us want to see companies that we're involved in or investing in, or like we want to see growth in top line and bottom line nonstop. And the more we see that, like, yeah, that's the best indicator that the growth is sustainable and that company is less likely to suddenly crash and burn. When we see growth on those aspects, then yeah, it's a great sign. Because companies that have strong cash positions, they have good profit margins, they have asset strength, and they have the foundation to support that growth, both in the short term and long term, it's great. And I mean, companies of all sizes, industries, different products, service mixes, they can all hopefully grow both revenues and profits consistently. But yeah, sometimes companies also have hard time to do that. And the difference many times comes down to the management approach to vision and execution and just overall who's on the team. So remember that while fast growth can be awesome, wonderful thing, it can also often require risky investments. If the company want to grow super fast, it can also be very risky. And that's why a lot of companies never make it past the startup stage. And those that make it into the growth phase, like many don't make it to maturity. You want it or not, to grow, every company has to take some risks. And if the leader miscalculate those risks, it can result in the decline of the company. So just to quickly summarize our thoughts on growth, remember this. Companies either continue to grow or will risk dying. Companies growing profitably, they tend to be more energized, innovate products and services, expand market share, and attract super motivated talent. Remember that the CEO's most important job is to make sure and ensure that there is a sustainable, profitable growth. And that's how he is able, with his team, of course, to create value for everyone, for different owners and shareholders. Remember that companies that are not growing, they can enter into a downward spiral and can die from, if it's higher costs, lower sales and revenues, lost market share, lower share price, cost cutting, reduction in force, demoralized employees, lost productivity, lost customers, and of course, more loss of market share and so on. And when that happens, the competition will take over their markets, customers, brand, positioning, and even their best people. Remember that the investment world, they will look primarily at the sales, the revenues, and the earning growth, the profits of a company when they try to value their stock price. And that growth is reflected primarily on a company's income statement, right? So both top line growth, like when you increase revenues, and bottom line growth, when you increase profits, they're super essential over time. It's also important to remember that if you see top line growth, like if you see revenues growth growing like crazy all the time, it doesn't necessarily mean that the bottom line growth in profits over time growth as well, right? Growth in profits usually, and again, there's no black or white, because some companies, when they are in the startup phase, they want to grow fast, even if they're not profitable. But growth in profits is more important usually, especially in a mature company, to see than just revenue growth. Remember that organic growth means basically anything internally, so anything internal expansion. So things like opening new stores, selling more products, entering new demographics or geographic markets. And that inorganic growth or external growth, it means merging with or acquiring new businesses to increase revenue. Remember that whatever is the growth expectations, it may change, right, based on the company's stage of development. And that high growth may be more realistic in the early years for a company, but may be less sustainable as the company matures and becomes kind of like larger and more complex. That's why it's super impressive to see massive companies like Apple or Google sometimes grow 30, 40, 50% year over year, because we're talking growth on billions and billions of dollars, which is, it's not easy to grow a small company on that percentages. So when you see their numbers, it's just super impressive. Remember that some of the risks of high growth include expenses that grow faster than revenue. A lot of time you'll see decline in quality of the product or service. And yeah, sometimes also burnout in employees. And that's how you see many companies that may grow sales and revenue rapidly, but lose money and they go out of business. Next, I want to talk to you about people and how they're affecting business and how they're related to understanding the financial acumen in a business. Maybe you heard that old saying that says that in business, you get what you want by giving other people what they want. Want it or not, people are the center of every business. They make decisions, they supply financial resources, they buy products, they provide the labor and services, and at the end of the day, they create and contribute to everything in the business. People drive cash, profit, assets, and growth. Good people make businesses. Businesses don't make people. You need good people to make great businesses. So meeting, exceeding, or even better anticipating the wants, the needs, the expectations of the business employees and customers, and then other stakeholders is essential to a business success. Now, most companies, successful companies, they recognize the need to satisfy both their employees and customers. And in the end of the day, what makes employees and customers happy is meeting their expectations. Richard Branson said that he's focused on making his employees happy, because if his employees will be happy, they will make his customers happy. If a business can do that, they'll get a satisfaction from both employees and customers, and then they'll get massive loyalty to the business. So to begin this section about people, right, let's begin this talking about employees, which are, as Richard Branson is saying, they're the foundation of any business success. Companies, in the end of the day, they want to attract the very best people with the best ideas. The best companies, they have a way of attracting the best people. And the best people, in the end of the day, help create even better companies. And I'm sure you heard the old saying that says like, A player hire A players, and B player hire C players. And it's interesting, if you look at the surveys out there, the number one reason employees leave their job is their relationship with their manager, actually. So no matter how many perks you have in the business, yeah, it might be great, but how people feel about their managers is much more important to their own employee satisfaction. If they don't have good relationship with their managers, and then if they don't have the opportunity to grow in their business, those things could really affect their time in the business. Because if they feel valued, if they receive regular praise, they're then rewarded for their efforts. They're then included in the decision making. And then they feel that they are contributing to the overall clear vision, right? And when that happens, when they feel part of it all, it's just far more likely that they're going to stay. Employees that feel that leadership doesn't know where they're going and who feel like they aren't valued, they always have one foot like out the door. And the funny thing is business is that most employers are generally unaware of these high dissatisfaction levels. In fact, usually the best thing managers can do is to take super personal interest in the career aspirations of their employees. And when you're talking about culture in a business, that's what we're talking about. So I want us to expand on that a bit, and just for you to understand the value of a good culture. In many companies, a strong, positive, employee-focused culture really helps ensuring that the employees get the relationships they want with the management. And then also like other perks that might even outweigh, let's say, the importance of a salary for someone. Every company, they should use their resources wisely, right? Like we said, we want to utilize our assets as best as possible, right? Because in this case, with people, we want to create a culture that can offer benefits that attract the top talent out there. And a small company that maybe can't afford to offer super extensive benefits, maybe they can offer something else, like a fun working environment, like a flexible hours, like the option to, I don't know, bring kids to work, or whatever other variety of features and options that might get the person that's working in the business more excited to be there. Because in tough economic conditions, especially when it's tough out there, like you want to find ways to do more with less, right? It's a very popular catchphrase out there. But at the same time, should be some balance here as well, right? Like if you try to do too much with your people, you risk burnout in your people. So there's always this constant ask of what can we do to make sure their employees are happy, right? Like thinking about like, okay, maybe better equipment and tools can improve the productivity without causing more stress in the work environment. What about more education to the employees? And the thing is, it's super hard to consider investment like this, like especially when there's financial uncertainty, because it's just super hard to calculate ROI here. But when you hear some of the biggest companies out there, like the most productive and profitable companies, they attribute their success in part to their commitment to ongoing employee training and support. It's the idea of treating employees as the internal customers, both of the company and of each other. You see that became super popular in the last few decades, right? Because it reflects kind of like the realization that the most successful companies have the best employees that are happiest. And in the end of the day, it's like you want to treat employees exactly like you want to treat your customers. And if you care about your customers and you're obsessed about them and about making them happy, then you want to do the same with your employees. That's why you hear people like Richard Branson and other entrepreneurs that consider their employees as their most important customers. And then many employees recognize that other colleagues that are working with them are also kind of like their customers as much. So your internal customers are kind of like the people you work with or serve within your organization. And you are the internal customer to others who serve and work with you. So it's always a good question to ask, like, are you meeting their needs and exceeding their expectations and vice versa? Like, what can you do or what are you doing to anticipate their future needs? And are you prepared to meet those needs? Also, as a business, you see a lot of time and you want to ask yourself, if you're involved in the business, like, have you performed some kind of survey or analysis of how well you're doing and where you are headed in serving your internal customers? Are you checking with them? Do you hold some kind of periodic meetings to discuss processes that can be improved, right? Or ways to improve and enhance communication and cooperations between yourself and your other internal team members. Now, a lot of those things that I talked about, a lot of it is many times in a business is kind of like the primary role of HR, like human resources department, to ensure and make sure that there's employee satisfaction and internal customer efficiency, right? And doing that by implementing kind of like the best effective training programs. And also adding to that constant feedback mechanism and facilitating those dialogues. So remember that while the revenue comes from customers that are paying, customers usually come from employees. And both in the end of the day are expensive to replace. All right, next with people, I want to move to talk to about customers next. So as essential and important as internal customers, employees that we talked about, as they are important to any business, in the end of the day, they are there to serve the external customers, right? External customers, the people who pay for your products and services. Those are the people that keeping your business alive. Customers are your lifeblood, your source of revenue and cash flow. Without customers, you're ultimately out of business. You need to wow your customers every day, or your competitors will eventually. And depending on the industry you operate, the cost of getting a new customer is usually 2 to 10 times more than the cost of keeping an existing customer. So you really want to keep the customers you have. Most businesses, they try to satisfy customer needs and expectations. Other companies even make a conscious effort to exceed those expectations with customers. And those usually are the best companies out there. That's why you see companies constantly survey their customers to find out their needs, right? And get recommendations and understand their desires for better or new future products and services. At the same time, customer feedback got its own limitations as well, because people can't always identify what is that they'll want in the future, right? Like Ford is saying that, he said that if you ask people what they wanted, they would tell him they want a faster horse versus a car, right? So at the same time, it's on the entrepreneur to anticipate and innovate. And history is full of examples of companies that failed because they failed to anticipate, right? Just think about Blockbuster and Netflix, for example. So in a nutshell, to summarize, here are some of the most important points on people. People are the most important resource for any company. Employees and customers are two super important stakeholders to a business. The most successful companies usually have a history of strong employee satisfaction and longer employee retention. So companies work super hard to keep their employees satisfied and happy. And also doing whatever they can to attract top talent to their company. When you think about satisfaction and loyalty, they are more of a result of expectations met than actual results achieved. So managing customer expectations is critical in creating loyalty. If you're not delivering on expectations, like delivering on expectations is essential. Remember that your customers, they're the lifeblood of your business. And you should focus on your customers like more than on your competitors, that's for sure. It's all about anticipating and innovating to meet unstated presence and future customer needs. That's the key to a long-term competitive success. When you look at the most innovative breakthrough products, they're not results of necessarily customer requests, but many times just the innovative and anticipation of the unexpressed customers. And also just an entrepreneur that think and find their needs and opportunities in the marketplace. Remember that customers, when they buy, they don't just buy products, they buy trustworthiness, they buy convenience, they buy prestige or some kind of a memorable experience. All those things are as important as just the product. In the end of the day, every company needs to also continue and study the environment in which they operate. Business should always continue to ask themselves like what changes are about to take place in the market and how will they most likely impact every driver of the business. And just constantly asking like how can we successfully be prepared for threats and take advantage of the opportunities we have in the market. So a business needs to commit constantly to ongoing study of what's happening in the economy, in the industry, and obviously in the markets that it operates in. And just quickly to add to that, remember that there are usually two external influencers that can affect the direction of a company. First one is the financial markets. So if it's a public company, of course, financial markets, they reflect the combined impact of all the other external factors. But financial markets, we mean the availability and the cost of capital many times. So that can be including things like loans from banks or other institutions. It means the difference in borrowing money by selling debt instruments, right? Like bonds or raising equity capital in the stock market. So financial and money markets can really reflect like the overall national and international rather than local conditions that will affect like how a business could behave financially. Like in the United States, you hear about the Federal Reserve that they set like key interest rates, and that's what influences the supply of the money nationwide. And that affects then, like, if let's say a small entrepreneur in their local community, if they can get a startup loan, or if a large company can raise capital to expand, and at what price, at what terms. So all of those things that they're greatly influenced by the federal policy. And then the availability and the price of the money, it affects the ability of all companies to grow or not, right? Because that's the difference between being able to innovate potentially on more products or being able to take more risks. So it completely changes this situation. The Fed, the financial markets, it affects and changes the capital that the company needs to make critical investment in assets, the access to capital, right? And the cost and the terms for the capital that will affect overall decisions and investment opportunities and decisions in different assets. So you want to look at companies kind of like homeowners in this way, right? It's kind of like, what's the ability to get a mortgage loan at a local bank is in the end of the day impacted by the federal monetary policy. Also, with public companies, the stock market plays an important role in directing the focus of the CEO, right? He wants the price to go up, to always be increasing. And when it's not the case, you'll see a lot of worried crowd around the business. Now, you might be asking, like, why should they, like the CEO and you, potentially be concerned about the company's stock price? So first, because the stock price is seen as a reflection of the market's confidence in the company's future performance. It's simple. People primarily buy stock because they believe that they will make more money as the stock price increases over time or through dividends that they'll get. But a company also benefits in different ways, in other ways when the stock price is higher. So the way they benefit in three different ways, starting with acquisitions even, right? So when the stock price is higher, the company can use fewer shares, so less shares, to buy another company. They can use their shares, their liquid shares, to buy other companies and use it as currency. Then, if the price is high, they can go out there and get more cash in secondary offerings, right? So when a public company sell more shares to investors in what we call a secondary offering, they can then sell a smaller percentage of the company to raise basically the same amount or greater amount of cash if the stock price is higher, right? You see that there was a story in the news lately with the Adani Group that thought that they were about to sell shares at a super high stock price, but then things happen in the business. There's a long story there, but the price dropped and they weren't able to sell the shares because they didn't want to sell at the lower price. And also the investors didn't want to buy at the higher price when they could just buy it at the lower price in the market. It also affects better credit rating, right? So one of the determinants of a public company's credit ratings actually relates to their stock price. With higher credit ratings, it can go out there and raise debt or equity capital at lower rates and with better terms. Another benefit if the stock is performing well is what we call it desirable stock options, right? So if there's an increase in stock price, it indicates that the company is successful. And when that's the case, the company can provide more desirable stock options to then be able to retain and overall attract super smart and talented employees. It's also a great, what we call buyout defense, right? So a higher stock price is a defense against a takeover. Because if the stock price goes up, so does the company's value, and therefore the overall sell price to buy it. And it's just more challenging if the price is super expensive. Also, I want to talk about buybacks for a second. So in addition to being focused on growth in sales and profits, companies can also influence their stock price through what we call stock buybacks. So what you see a lot of times is that companies use their excess cash to go and buy back their own stock. And by doing that, they reduce the overall number of shares outstanding and they increase the what we call earning per share. So the profit per share, which is again just a ratio, right? But it's another measure to determine the value of the company. And generally when that happens, this tactic will usually increase the stock market price. And the way to look at it, like one justification is that buying one's own stock shows that the company management believes in themselves. They basically say, look, we're investing in our own stock, which they believe will give the best, highest, safest return compared to other assets or investment opportunities. So this approach just, the reason that a lot of entrepreneurs, owners, shareholders are doing that is that it really increase and raise confidence for investors And of course, it then encourage them to also go and buy the stock, and that will increase demand and hopefully the price. All right, so that's about people. Now it's time to move and do a deep dive into the financial statements and understanding what we call the annual report. So look, financial statements can seem overwhelming, but they don't have to be. The key here is to understand that unless you're a CFO or a financial analyst or a commercial loan manager, you don't have to understand everything in those statements to really find and discover like super important rules about the health and sustainability of a company. I'm going to explain what financial statements can reveal and show you the most important numbers, and then metrics, and then measures to look for and what they mean for a business. We're also going to go through and I'm going to explain the basic of an annual report, which is where you'll find these financial statements, at least for public companies. So let's start with the 3 financial statements, also called as the financials. And those are the financials that, especially for, again, public companies, every public company, they prepare them and they share them with the public. Those are the income statements, the balance sheet, and the statement of cash flows. You will also often hear the word consolidated used with these statements, which simply means that figures from all subsidiaries and business units are included in the financial statements. Public companies must also file quarterly reports and annual reports, also known as Form 10Q. And public companies, I'm talking US right now, they do it with the Securities and Exchange Commission, the SEC. And those are then made available to the public for anyone to see. When we're talking about private companies, privately held companies, they prepare also usually all those statements, but they do it for tax purposes. And because it also helps for business owners to understand how the company is performing. Now, the income statement, also called the profit and loss statement, or P&L in short, it reports revenues, expenses, and bottom line, so net income or profitability. And for public companies, you'll also see it includes what we called earnings per share of stock. The balance sheet, it shows companies' assets, liabilities, and shareholder equity, and therefore reveals the financial strength of the company. So when analyzed with the income statement, it also reveals how efficiently assets are being utilized. The statement of cash flows, it reports where a company gets its cash and how it then uses it in 3 activities: operations or core business activities, investing activities by buying and selling assets and financing through receiving and paying loans, selling and repurchasing stock, or paying dividends. All those are kind of under the 3 categories. So these 3 statements, they connect like puzzle pieces, right? So the income statement begins with revenues and ends with net income. And then net income in the statement of cash flow is going to be the first line, right? Which then shows how cash is flowing into and out of the company, to end with a calculation of the current amount of cash and cash equivalents on hand, which is basically the cash position. The balance sheet then begins with cash and cash equivalents and outline then other assets and liabilities to then help to get to a calculation of shareholders' equity. So the 3 statements, they start with a reflection of the activities of the company, and kind of like how it engages with its customers. So a company is going out there, engaging with customers, they're bringing revenues. And then those financial statements, they basically create some kind of a bridge on how those activities then drive greater value for shareholders, which is the shareholders' equity. So when we talked about the 5 key drivers, they're not just a theoretical model of what is important to any business. They are based on the reports that all business leaders use to track financial performance. These financial statements are critical because they track the elements of a company that can lead to its success or its failure. So cash, profit, assets, and growth over time. So remember, cash we can find in the statement of cash flows. Profit we can find in the income statement. Assets in the balance sheet. And growth, companies seek to grow, right? So the results measured on basically all 3 financial statements. And of course we have people, right? The activity that these financial statements reflect is, in the end of the day, how all employees are out there providing value to customers. So let's continue to dive into the basics of financial statements. And remember, you don't have to necessarily understand every line item on the financial statement to understand the statement's basic message. All you need to know and worry about is to know which primary, call it switches, turn on the right truth of the company's financial health. So we're going to begin with the big picture breakdown for those people who are only interested in the, let's say, highlights, and then we're also going to dive deeper. And I'm going to walk you through line by line for those if you specifically think that you just want more in-depth understanding. But before we dive in, there are a few basic rules and hurdles that you should be familiar with, because they will help you make sense of most financial statements. So first, maybe you remember from the discussion that we had on accrual-based accounting that most big companies, they follow that approach. And when a company follows accrual-based accounting, that influences when revenue and when expenses and profits are what we call booked or recorded in the accounting system, and when they appear on the financial statement. Second, one thing to remember and understand is that in the United States, all audited financial statements, they're prepared according to rules that are established by the accounting profession and governmental agencies. So these generally accepted accounting principles are known as GAAP. They're developed by the Financial Accounting Standard Boards. So you'll see the SEC requires that the financial statements of all public companies be prepared according to GAAP. And those same rules are also used by the IRS to calculate the company's income taxes. When we're talking about companies outside the US, they often follow what they call the International Financial Reporting Standards, known as the IFRS. Third thing to know is that the amounts on the financial statements of a larger companies are often what we call truncated. So at the top of the statements, you will see notation that says sometimes in thousands or in millions, which basically means that when you read the numbers, you want to add, you must add those missing zeros to get the actual number. So for example, if you see $470 is actually $470,000 if the statement is presented in thousands, and 470 million if the statement is presented in millions. For small companies, the exact figures are usually shown, but just be careful when you look at financial statements to check for this notation so you read the financial statement figures right. Fourth quick note, just before we dive in, is that even though the fundamental organization of financial statement is consistent, you'll still see companies that may label items differently, right? Which can sometimes make reading financials a bit of a challenge. You might see someone, instead of writing revenues, you'll see net sales, for example. You see it many times, the financial statement of a company in one industry might look different from those of the company in another industry. If you look at financials from a bank and financial or just financial institutions in general, they will look very different than financial statements from a retailer. But trust me, after you're going to review few financials, you'll be able to understand most of the major entries. Next, I want to explain the most common line items and the different terms that you might see that is used to communicate the same thing in the end of the day. And just keep in mind, remember, with numbers, they're only meaningful within a certain context, right? In the end of the day, there's always a larger story involved on how a company arrived to numbers. So whenever you're looking at key measures on a financial statement, just a good practice would be it's going to be super useful if you're going to review those different statements from 4 different ways and things around it. So whenever you look at an item in a financial statement, the first thing you want to look at and think about is the amount, right? The amount of the item, which you may want to be positive or negative, of course, depends, or as high as possible, like revenue, or as low as possible, like cost of goods. The second thing you want to approach every item on a financial statement is looking at the trend. So the trend, you want to look ideally at the trend over, let's say, the last 3 or more years, right? You want to ask yourself, is the item going up or down, and by what percentage? And also why? It's always good to ask, is like the rate of that item, like the change is accelerating, it's slowing, and is this kind of like the right direction for the company, seeing things accelerating or slowing? Depends on what we're looking at. Third thing to look at. So the third thing to look at when we're looking at items on financial statements is we're looking at the ratio, right? So the ratio of the item to other relevant items. So you should also look at the trend of the ratio. And I'll explain in a bit what ratios to review for some key line items in each financial statement, just in a bit. Fourth thing to think about is approaching things from an industry and competitor analysis. So you always want to look at an item and then ask yourself how these numbers compare to the industry and overall just key competitors. So it's always good to ask like why one company is doing better or worse than the other, especially if they're in the same sector. So now when you understand those basic principles about financial statement, now the question is, okay, cool. So where can you find them? So if it's a private company, you'll need to talk to the CEO or the accountant for that and just ask them for access. If it's a public company, right? So for publicly held companies, the financials, along with a lot of other information, they're usually very much readily available in their annual report. And you can quickly just pick a company's name and just Google annual report. Google a company name, Google Facebook annual report, and you'll see tons of websites that can help you with that. So now the question is, assuming that you are in front of the annual report, okay, cool. So how do you now read an annual report? And I've already mentioned the annual report that also called the Form 10K, that public companies are required to file with the government and make available to all shareholders. And it consists of about 15 items that a company must address. Now, the great detail and disclosure in these reports are intended to help shareholders to understand the business they are investing in. That's the goal of putting as much information in there and disclose everything pretty much. Now look, a lot of the information in the 10K report content is super important, but the following three things I'm going to talk about, they're super valuable. So in analyzing a company, especially like because this is where the financial things are at. So item number one, when you look at the 10K report, is what we call about the business section, right? So this section of the 10K provides some kind of a basic overview or description of the company. And it might include information about product or service lines or how it conducts business and customer information and things like that. Then item number 7 in the 10K form is all about kind of like management discussion and an analysis. And that part also usually you'll see some kind of a preview opportunities on opportunities and potential problems with future performance in the business. Now, this part can be sometimes super long and technical, but I really encourage you to read it if you're interested in the company, because it really discussed usually the most important kind of like happenings in the business. And then item 8, of course, which will show you the financial statements. And here in item 8, you'll usually find all the 3 key financial statements we referred to. You'll then see in public companies, those financials are accompanied by auditor's report. So it's some kind of a letter signed by independent accounting firm that basically affirming their performance in auditing the financial statements. Also in item number 8, you'll see notes to financial statements, which is basically a collection of supplemental information that is related to the financial statements. Now, in addition to the Form 10K that's filed with the SEC, most public companies will produce a much more, call it reader-friendly version of their annual report. And like you see it sometimes even with private companies who are not really required to file in Form 10K, maybe sometimes they'll even publish some kind of an annual report to make sure that they have a way to communicate to their stakeholders kind of like their assessment of the last year. Now look, there are no 2 annual reports that are going to be 100% the same, right? So because there are no standards or rules like in the 10K. So what you want to look for is, and read basically the following. So look for financial highlights first. So analysts and investors, they often start a review of an annual report with the financial highlights. Sometimes you'll find these highlights on the inside of kind of like the front cover and perhaps spilling across 2 or 3 more pages. These highlights, they're going to be extracted from the complete financial statements. And you'll typically see usually at least 2 years of data that is summarized, perhaps even more. Next, you also usually see there kind of like a CEO's letter to the shareholders. Generally, you'll find a letter to the shareholders signed by the CEO. And this letter is usually very important, so you want to read it carefully. That's where the CEO, you see him talking about the issues and initiatives and kind of like the most important things related to the company. Usually this letter will always be kind of like in a positive spin, right? Even if it was a bad year, the CEO will always know it, but most of the time he'll comment about kind of like how bright the future looks like and how the company is on its way back and going to have the best year next year. But remember that this letter is just a good place to find out what went on kind of like during the previous year, what the outlook for the future is, and what strategies are important to the CEO. But overall, this letter is just a good place to find out what went on during the previous year. Right, so kind of like what's the outlook for the future is and what strategies are important to the CEO. Most of the time, you'll see that the drivers that most frequently addressed by almost every CEO of a public company in these letters are talking about growth and profitability. And then you also see CEOs that reference their people by discussing the company's customers and employees. Now, if there are specific initiatives for improving profitability, you'll find references to margins or maybe different cost or expense reduction. So if you'll read this letter and keep a simple tally of like how often cash, profit, assets, growth, and people are referenced, you'll get an idea of which drivers the CEO is focused on. You'll also see that in a lot of those reports, there's kind of like a lot of marketing and design involved in those. Like many annual reports are prepared with like super colorful photos and graphics and just overall glowing look. So a lot of them read almost more like kind of like a marketing brochure than financial report, because they actually are. Like the letter from the CEO, like that's the marketing portion of the annual report. It will typically have kind of like a super positive spin, right? But reviewing this information will give you insights into the company's products, customers, culture, and so forth. So look, while reading every line of a company's financial annual report or 10K is almost never necessary, a review of key items is kind of like a surefire path to understanding the company's health. And also just overall their current situation, their goals, and their chances for any long-term success. My goal for this next part of the video is to simplify the financial statement so that you can basically get in and get out with what you need within a few minutes. So just a quick summary on what we just talked about. The income statement, the balance sheet, and the statement of cash flows, they are the financial statements that reflect the performance around key drivers of a business. When analyzing numbers on the financial statements, you should review ideally 4 basic characteristics: the amount, the trend, the ratio, so basically the amount compared to other numbers, and you'll want to do comparison to competitors ideally in the industry. Also remember that public companies, they're required by the SEC to file Form 10K, which is an annual report that contains the 3 key financial statements in it. And while there are standard kind of like 15 items in the Form 10K, those 3 that we refer to are, I think, the most important to look into. So item number 1, it's about the business, very good to go through. Item number 7, that all about kind of like the management discussion and analysis, which is also known as kind of like the MD&A. And item 8, the financial statements and supplementary data. So remember that companies may choose to release an additional annual report that's easier to read than a Form 10K. And that the purpose of this annual report is to communicate the company's strategy, market, and brand the company and just overall share financial highlights. All right, so now time to move on and really do a deep dive into our financial statements. And we're going to start with the income statement. So the income statement, what that is, it's basically also referred to as a statement of earnings or a statement of operations or profit and loss statement or P&L. The purpose of an income statement is to show whether the company made or lost money during the period being reported, usually a quarter or a fiscal year. And then it helps to show whether a company generated a profit or a loss. So this is one reason why many companies refer to their income statement as a profit and loss statement. which is a sign that it's going to teach us something about their profit driver. But the income statement also reveals important information about the growth of the company, because an income statement typically provides data for obviously whatever reporting period, if it's a quarter or a year. And many times you also see data from the 2 previous periods. And then when you have different periods, it's very easy for you to see the growth in key measures from kind of like one period to the next. And every financial statement is laid out based on a simple formula. In every income statement, it will always start with revenue, which is kind of like at the top line. Then it's going to subtract expenses, and it's going to end with a calculation at the bottom with the net income or net profit, the bottom line. So the most important thing to remember in an income statement is that we have revenues minus expenses, and at the bottom, we're going to see the profit. A cool way to think about the income statement is like climbing down a ladder, right? So the top represents your sales, your revenues. Then you'll have kind of like a bunch of steps down that represent different costs or expenses. And finally, the bottom run, right? That represents your profits, or how much you made after you subtract like all expenses. When you're thinking about, let's say, a family budget, it follows a similar formula, right? You earn money from your job and maybe some investments, right? So this is kind of like your top line in an income statement. Then you subtract your mortgage, your car payment, your gas, food, entertainment. Those are your expenses. And what's left over kind of like at the end of the month is your bottom line, right? And hopefully it's not negative. Because if the bottom line is negative, you start to look for trends, right? You want to find ways to control your budget, like maybe eating out less to control your food costs. Now, while a bit more complex, business leaders use the income statement to make equally important decisions to keep sales and profit growing. As we explore the income statement, I'll first give you, what we're going to do is first give you like a big picture breakdown, so that you can just start to get kind of key information from any income statement you want, like in a matter of minutes, right? And for those interested in more details, we're going to do after that a deep dive as well on this. So let's start with how and what do you want to see to get everything you need from an income statement? Let's say if you have just a few minutes to look at it. So the first thing you want to look at is the revenue growth year over year, right? So total revenue, also called sales. And that's, like we said, refer to kind of like the top line, right? Because that's the top of the income statement. So what you'll want to do is you want to look at the revenues, totals, right? But you want to look at all the 3 periods. So let's say you have 3 years ago, last year, 2 years ago, last year, this year, right? So you want to ask yourself, okay, what do I see? What's the trend? Is revenue increasing? If so, great. If not, then that's a red flag that you want to look into. Because when you see kind of like a steadily decreasing revenue over time, it's a sign that the company might be struggling. Next thing you can do is you can go and calculate the rate of growth, right? Using the formula that I'll just give you right now. So what you want to do is you want to take your current revenue, right? Whatever year you're looking at, look at the top line, take one number from 1 year, take the revenue, then do minus the previous year revenue, and whatever you got left with, divide it by the previous year revenue. Okay, so let's repeat that. You take the current year revenue minus the previous year revenue. Whatever is the result, you then divide it by the number of the previous year revenue. Then you take that number, you multiply it by 100, and that's equal your growth rate percentage. Right? So it's very good to see kind of like, okay, how much percentage am I growing year over year on my revenues or not? Always one of the best things you can do to start with, to always good to compare kind of like the growth rate for the past few years that you have access to. And even if the revenue is going up every year, if you see a declining rate of growth in revenue, it might indicate that, we have some problems with kind of like the overall long-term viability of the business. Especially if the economy and that specific industry that the business is in have been strong. So that's the first thing, right? We want to look at revenues. Let's see the percentage. Let's see if there's any growth. Next, we want to look into is the net income. And similar, right? We want to look at net income growth year over year. So take the net income or profits, right? Or whatever you're going to see there at the bottom line in the income statement. So remember, always you want to look at the bottom line, the profits, the net income, right? Even though in public companies, you'll see earnings per share is presented usually below in net income, we do want to use the net income right now with our calculation. So we want to ask ourselves, like, has it been increasing over time? has the rate of growth been steady or improving? If not, we also want to maybe compare it to the revenue, right? Like what's the growth percentage in net income compared to the growth percentage in revenues? Like for example, if revenue is growing, but the net income isn't, it means that your expenses are growing faster than your revenues, which may not be a good sign. But at the same time, it depends on the business, right? And what they're telling you, because some business strategies might increase expenses and reduce profits in certain periods, like if they want to invest in new product development to make the company more profitable in the future. So if profit is declining, just do some research to see if the company leaders, let's say maybe they have made those type of investments with keeping the future in mind. Another thing you want to look into is the net profit margin. So if you divide the bottom line net income by the top line total revenue, you have now calculated the net profit margin. It's also a great number to look into. When you calculate the net profit margin, it helps you, it reveals how much profit is generated by each dollar of revenue. And obviously you want your revenue to produce as much profit as possible, except like when you are, like we said, reinvesting potential profits into the company as part of some kind of a growth strategy. So literally just those simple few points that we just mentioned, that's how you cover the income statement in a matter of minutes. If you want to go deeper, then you'll want to review few more measures. We'll want to talk about revenue, cost of goods sold, gross profit or gross margin, operating income, net income, and earnings per share. Let me walk you through each of them right now. Right? And as I walk you through each of these 6 measures, it's important to remember that different companies will use different terms in their financial statements. But if you remember that revenues and sales are basically the same, and that income and earnings are basically the same, and profits also are basically the same as well, it will just be easier for you to read any income statement. So we discussed earlier that the 4 characteristics of a financial measure, which are the amount, the trend, the ratio, and industry or competitor analysis. While I'm not doing it for every line item, I will do it with you for kind of like the most important ones, right? We're going to go through the most important ones. And you could, of course, do it. You could pretty much do those calculations for any line item that is of interest to you and then compare those things to different peers and whatnot and competitors. So let's start with revenue. Remember, revenue is the dollar amount of goods and services sold as a result of the normal business activities. A company's health depends on how well it makes money doing what it normally does, right? So it's not from extra non-recurring activities such as selling a business unit. Revenue is sometimes referred to as sales, gross revenue, or operating revenue. So the total revenue, the top line, is, I'd say, one of the key measures to examine on any income statement. Like usually when you even hear company says that they grew by X or Y%, it's talking about growth in revenues most times. So what's important here is actually the comparison. Like you want to ask yourself, like we mentioned in the quick calculation of the income statement, is we want to ask yourself, like, is revenues trending up or down if we compare to perhaps even other companies in the industry. Next, let's talk about cost of goods sold for a second, which is after revenue. So there are several categories of expenses that listed after total revenues, but many P&Ls, they will list cost of goods sold, the COGS, which is sometimes called cost of sales, right? So usually it would be kind of like first line item under revenues. Do you remember what COGS, what it is? So COGS, that basically includes the cost of purchasing inventory, like raw materials, cost of product assembly, and other costs that are directly associated with producing individual products. And by the way, you'll notice that as an accounting practice, none of the numbers in the expense categories are shown as negative, right? Everyone just knows that expense are deductions from revenue. And remember that it's very common to see COGS increasing when revenue is increasing. And what you want to watch out for are increases in COGS as a percentage of revenue and seeing what happened there. Next, let's talk for a second about gross profit and gross margin. So even though, if you may recall, gross profit is an important indicator of profitability, and gross profit margin is an important measure for certain industries, especially like manufacturers or retailers. Right, so few income statements have a line item labeled gross profit, but it's very easily done, right? You're just subtracting the cost of goods sold, right? You're basically subtracting COGS from the total revenue. So remember gross profit. So remember gross profit equal total revenue, right? The top line minus cost of goods sold, basically, right? That's gross profit. It's just a good number to have, especially in certain industries. And then usually if it's important to you to know, you'll also want to add to that the gross profit margin, or gross margin in short. All right, it's basically gross profit as a percentage of total revenue. It's important to measure because it indicates how much profit is being generated from your sales, but before subtracting any overhead and other type of expenses. So to some degree, it's basically a kind of a ratio of efficiency and profitability that is very common. If you watch Shark Tank, they very much like to ask for it. To calculate gross margin, you simply divide gross profit by total revenue, and then you multiply it by 100, right? So remember, if you want to know your gross margin for a business in a specific period, you divide gross profit by total revenue and you multiply it by 100. Next, let's talk about operating expenses. So after the cost of goods sold, the COGS, after they're subtracted from the total revenue, operating expenses, they're itemized on the income statement one after the other, right? So this is one area where you may find like dramatic differences from company to company. And this is where I like to compare like this area on what the competition and other companies in the space are spending. So in this area, you'll find things like R&D and sales and marketing, and also G&A, or general and administrative expenses. This line item also includes rent, utilities, and salaries of corporate staff like finance, HR, IT. Next in the P&L, you also see depreciation and amortization. And just to give you an idea of what that is, so according to the SEC, depreciation basically takes into the account the wear and tear of some assets, such as machinery, tools, and furniture, which are used over the long term. So what you see is companies basically spread the cost of those assets over the periods that they are used. It's a bit complicated concept, but it's also good to know about it. So this process of spreading these costs over time is called depreciation or amortization, and it depends on the type of asset. So the charge for using these assets during a specific period is a fraction of the original cost of the assets. And every different assets have different rules on what that looks like. So the IRS gives specific guidelines for the number of years that different type of assets can be depreciated or amortized. And you see that like in the real estate space, a lot of real estate investors really enjoy investing in real estate because they receive depreciation in there. So because overall, if you have higher deductions, like higher expenses in any given year, it's just going to result in lower taxable net income and then lower taxes, which is why, like we said before, reinvesting profits into a business is a tactic companies are using, because it's not only helping them to grow, but it's also helping reducing the tax burden. Next, let's talk about operating income for a second. So once all the operating expenses have been accounted for, right, there is enough information to calculate operating income. It's a very important number that shows how much money the company is making from their core operations or basic business activities. Operating income is the profit from core operations, what's left after the cost of goods sold and operating expenses are deducted from revenues. And then before subtracting additional expenses that most employees and managers can't really control, like interest and taxes. So that's when you hear operating income for many companies is often referred to as earnings before interest and taxes, or EBIT, if there are no usual expenses in addition to interest and taxes. That's the assumption here. So operating income shows kind of like how well the company executes its core business functions, kind of like day to day, right? Because of this, some analysts and finance professionals and CEOs, it just gives them a better indicator of profitability. And many times, it's a better indicator compared to net income, for example, because net income have a lot of other expenses that then are not necessarily in direct relation to the overall day-to-day operation. Now, when you look at that number, obviously, ideally, this figure should be increasing, right, in dollars every year, as well as hopefully increasing the rate of growth year over year. And operating income or profit as a percentage of revenue. So if you take operating income divided by revenue or operating margin, which is what we're getting, is a super important ratio called operating margin. And the operating margin, like if you're going to compare industry to industry, it's going to be completely different. It can vary dramatically from industry to industry and also from company to company. Another thing you might find in the P&L is other expenses and income. So non-operating expenses are those costs that do not relate to the business of like basic operations of the company. So in there you may find line item in this section labeled like non-operating income or expenses, which can be, let's say, a sale of an asset or a business can be in here. So these incomes or losses would be listed in this section because, like I said, they're not part of the company's core operation, so it's going to be different. In there, you also find interest that is paid. If the company has some debt, you'll find the interest expense in there. Also, like in this case, you might be wondering like why companies borrow money if they seem to have a lot of cash on hand. And there are several reasons for that, like including, for example, if you have an opportunity to borrow very cheap rates, with having the desire to keep plenty of cash on hand for future investments for growth. To add to that, by the way, you also find in this section taxes paid and taxes accrued. So owed, basically, but not yet paid. Next, let's talk a bit about the net income or net earnings, the bottom line. So it's all about, we mentioned that before, but just to put super important emphasis on that, it's all about how much net income or profit did the business make after all expenses were paid and all revenue was accounted for. This is the bottom line, and in many ways, it's the most important figure on the income statement. If it's positive, that's a strong starting point, right? And if any net income is increased each year, that's even better. We always want to see that numbers going up if possible. And then like any important number, we want to also see the rate of growth between different years, right? It's also very important to check. So let's check the net income as a percentage of total revenue. That's called the net margin or net profit margin. So basically you just take the net income and it's divided by revenue, right? Or bottom line divided by top line. Because when you look at a company, if they're able to contain the rate of growth of the company's cost to be less than the rate of growth of its revenues, that's a good sign. But then if the net profit margin were decreasing, it would mean that sales were growing at a rate less than costs. That wouldn't be necessarily a good sign. And that's why in the end of the day, you see companies with like super unique offerings like Apple, for example, they typically have higher margins, while companies like, let's say Walmart, that sell commodities, they have lower than average profit margins. Next, let's move to talk about earnings per share. So for public companies, income statement will include a final entry that calculates the earnings. So basically the profit generated per share of common stock outstanding. It's the EPS in short. Some would say that it would be the most important measure to determine a company's share price. Why? Because for any investment, the more profit it generates, the more valuable it is. So a company that is able to earn more per like each share of stock over time, it will see the stock price going up. And to calculate earning per share, they're calculated by dividing the net income by the average number of shares of common stock outstanding during the year of a specific period, during a year or a specific period. So let's just do a quick summary on the insights from the income statement. The income statement measures profitability. The income statement formula is revenue minus expenses equal profit or net income. It shows top line revenues, right? So the sales. Then it deducts all expenses and shows bottom line net income or profit. The income statement is a financial motion picture, right? So it's showing a company's performance over a period of time, such as month, quarter, or a fiscal year. The income statement is also referred to as the statement of operations. Statement of earnings can also be the profit and loss statement or the P&L in short. Some key measures and things to watch on in an income statement are total revenue, gross profit, operating income, net income, and earnings per share for public companies, specifically for this last one. Remember that the net profit margin is basically taking the bottom line net income or earnings as a percentage of total revenues or sales. And everything you do to impact profit, primarily increasing sales or reducing expenses, including cost of goods sold, All of those things influence the bottom line of your income statement. Next, let's talk about the balance sheet. So what is the balance sheet? The balance sheet provides information on assets, liabilities, and equity factors of your asset strength, and along with the income statement, indicators of how effectively your assets are being utilized to produce a return. So in a simple way, just like the income statement, the balance sheet follows a basic equation, which is asset minus liabilities equal equity, or assets equal liabilities plus equity. Now, assets, those are the resources and items that you own that have some kind of economic value, right? Such as like cash or accounts receivables or buildings, equipment, and other things that you use to produce revenue or income. Liabilities, those are debts you owe, such as bank loans, accounts payable, mortgage loans, things like that. Equity, or stockholders' equity or net assets, is what the owners would have left after assuming selling all of the assets and paying off all the liabilities. So asset strength is a super strong indicator of overall financial health. And let me tell you why. Because in times of trouble, a company can rely on its assets. Think about it this way. Like suppose you as an individual, let's say you have plenty of cash in savings, right? And investments or whatever different types, right? Maybe you even have good equity in your home. So all of those are assets, right? And let's say you have very little debt. If that's the case, you're just more likely to survive whatever happens, whatever downturn happens, you have more chances to survive financially during a downturn, right? Or let's say if you lose a job, aren't you? And same principle is true for companies. So remember, asset strength is primarily measured in terms of liquidity. So how much cash and cash equivalents are available or could be generated quickly by selling assets. And also the relationship of liabilities to assets and equity. And in the end of the day, all of us, like in a business, you want your assets to be greater than your liabilities. And the more equity you have, the less risk you carry. Let's say if your company has a loan of 1 million to be repaid in 90 days, and it has $5 million of cash or assets that can be turned into cash within 90 days, it's in pretty good shape. But if it's the reverse, well, it's a problem, right? Good luck. So next I want us to explore the relationship between assets, liabilities, and equity just a bit more before we dive fully into the balance sheet. And let's start with overall understanding why the balance sheet balances and why more equity equal potentially more risk. So remember, assets must equal liabilities plus equity. And let's explore why. Again, let's just have a simple example. So let's say you want to purchase a home, right? That's an asset, right? And the price is, let's say, $200,000. Where do you get the money to buy it? So you might take an 80% mortgage loan, which is kind of like liability for $160,000. And you make a down payment of $40,000, the difference, right? Which is your equity. So the capital you use to buy your home, your $160,000 liability mortgage loan plus $40,000 in equity, right? The cash down payment equals $200,000, which is the price of your asset. But now, suppose you get very lucky and within 6 months of purchasing the home, the market goes up and your home is now worth, let's say, $50,000 more, right? So you haven't even paid down the principal portion of the mortgage loan that you have, right? Maybe just a bit. And now you have $250,000 assets, right? Equals your $160,000 liability plus your $90,000 right now. Your equity, right? Remember, so it's the $40,000 plus the $50,000 in additional value. So the market conditions, the $50,000 jump in value increased your equity in the house. And this is exactly how a balance sheet for a company works, right? The balance sheet shows your company assets and the source of capital, right? So cash basically used to acquire and fund those assets. And the balance sheet balances because it shows that the money to purchase your assets came from or balances with the total of what you borrowed, the liabilities. Plus, you add to that what you earned or contributed from your own pocket, the equity. So the home example is also a good example of why asset strength and strong equity are basically equated with less risk. Because let's go through this, right? Let's say that instead of increasing in value, your home value dropped by 50,000. What's going on right now is that your 150,000 home would equal your 160,000 liability plus 10,000 in negative equity because the value of your home decreased. And that's what you would have to pay for the bank if you sold your home today, right? If you wanted to maintain good credit with the bank. And yeah, of course, if you're still able to make your loan payments, then negative equity may not be a problem. You can continue like that for as long as you can pay your payments for the bank. But if you had more equity from the start to offset overall the liability of the loan, then that drop of $50,000 wouldn't have resulted in negative equity. Or maybe if you want to look at the full picture, let's say if you had other assets, like maybe if you had $15,000 cash in the bank, that could help you cover your overall negative equity in your home, and that wouldn't be a problem. But if you didn't have assets to cover your negative equity, that would basically make you a risky borrower, right? So again, this is just to give you a personal example of what companies can go through. And this is why banks, investors, analysts, they always review the balance sheet very closely to determine like how risky it is to loan money or to invest in or buy stock in the company. They want to see enough asset strength to cover all of the eventualities that businesses are exposed to every single day, such as a potential downturn in the market or the failure of a new product. Like if you look at the 2007 crisis, right, a significant contributor to the credit crisis that began in 2007 was basically financial institutions lowering their lending standards, right, and basically accepting riskier loans, right? So they gave tons of loans with borrowers that invested very little of their own money, right? Let's say 5%, and they gave them the rest of the money. And when that happened, when the value of the homes dropped, many lost all of their equity. And their incentive to keep making payments to the bank in 2011 or so, right? About 1 in 7 homes was underwater. And back then, when loans for banks went south, right, they had less money to lend to others, including businesses, affected everyone. So to help you understand how quickly you can get key indicators of a company's financial strength from the balance sheet, we're going to do a quick breakdown to understand the balance sheet in a matter of minutes. And after that, we're also going to do a bit more extended version. So let's do it. Let's start. So what do you want to see when assessing a company through a balance sheet? And let's say you only have a few minutes to look. So if I have only a few minutes to check a balance sheet, first, you probably want to check their cash position. So remember that a company's cash position is the amount listed for cash and cash equivalents on the balance sheet. So basically, how much it has on hand or how much they have in accessible accounts at any point of time. And a company should have a strong cash position on its balance sheet so that it can weather tough times or take advantage of opportunities. And the worse the economy or the industry is doing, the more cash you want to see on hand in a business. Second thing I'll probably want to look into is like you want to check the cash position change, right? So basically, how has the cash position changed, let's say year over year or quarter over quarter, or whatever you want to compare it to? If it has increased, that may be a good thing, unless the company is holding on to too much cash, right? Remember, cash earns a pretty lousy return because if there's too much cash, we want to ask questions, right? Like, why there's no investments in the growth of the company? If the cash number decreased, then we also want to ask why, right? Like, has the company used cash for some big investments for potential future growth? Like Facebook, Meta investing in the metaverse, right? And that's the reason for all those expenses and perhaps lower amount of cash. Or have revenue and profits been dropping? We want to know those things. And if that's the case, that's why maybe that situation was forcing the company to dig into its cash to keep the doors open, right? If revenue is down, profits is down, and guess what? The company needs to use their cash to just sustain themselves. So that's a red flag. Next, we want to check the equity ratio. The equity ratio is total shareholders' equity divided by total assets. And it's expressed as a percentage, right? So we divide it right? So total shareholders' equity divided by total assets expresses a percentage. So we need to multiply it by 100. So if we see a high or a strong equity ratio, it means that more of the total assets are financed by shareholders or owners' equity than by liabilities or debts. And also here, every industry is different. Like you'll see, if you're going to look at banks ratios, you're going to see lower ratios than compared to, let's say, high-tech companies. And a higher ratio usually just means that a company has more equity to borrow against if there is any need to, and also the ability to borrow money. You need to remember it's an important factor in the potential growth of the company. Next, you'll probably want to check what we call return on assets, so ROA, which is it measures basically the profit generated on the company's assets. Remember that the purpose of an asset is to earn return for the stakeholders, right? And profit is the best form of return. Now the equation for it is you take the net income, so the net income divided by total assets, and then expressed as a percentage. So we need to also multiply by 100. And in here as well, the higher the percentage, the better. Like for example, if you look at the S&P, the average there fluctuates by industry, of course, and whatever the economic condition, and of course by company. So that's what I would do. Those are the things that I would look at if I just had a few minutes. Now I want to do a bit more of a deep dive into the balance sheet, like if you have more time to spend on it. Now remember, a balance sheet is a snapshot. It's a snapshot providing a financial picture of the company on a specific date. So we're taking a snapshot in a specific date that we want to check, and it's usually kind of like the last day of the month, the last day of the quarter, or a fiscal year, where we take a snapshot and we're looking at the situation. The most important line items on any balance sheet, and the ones we'll fully analyze in the following minutes, are those ones. First of all is current assets, especially like we want to see cash and cash equivalents. We want to see total assets, we want to see current liabilities, we want to see total liabilities, and we want to see shareholders' equity. So let's start with current assets. A balance sheet always lists assets in the beginning with those that are, first of all, most liquid, right? So those are the current assets. Current assets are those that the company expects to convert to cash within 12 months. And it's important to note that the dollar amount of assets included on the balance sheet is typically the original cost of the asset, less any what we call accumulated depreciation. So for example, inventories, when you see them on the balance sheet, they're usually valued at either cost or market value, whoever is lower usually. And you see those different accounting rules because it helps guard against like inflating the value of assets, but they might also lead to understanding better kind of like the true value of the company. So for example, let's say a company purchased a building 30 years ago, right? So it might show no value for the building on the balance sheet because the asset has been entirely depreciated or basically written off over this period. But the building might still be in good condition and valuable if sold. So possibly worth even more than its original cost. That's why you see many that will value it or evaluate companies based on the fair market value of their assets, not the dollar amount on the balance sheet, which is their book value. Those are different terms to look at. Now, cash, it's the most liquid asset, right? So that's why it's on the balance sheet, it's listed first within the current assets. It includes funds in the bank and some other financial accounts as well as cash equivalents. And remember, cash equivalents, they're basically almost as liquid as cash. Things like interest in a money market fund or whatnot. Now, the reason that this is such an important line item, like we discussed before, is because it really reflects the company's flexibility or their ability to take advantage of opportunities in the right time if there's something coming their way. Right? Remember, if they have access to cash, they can go out there, they invest in new product, they can buy companies, they can survive through downturns better than someone who have no cash. And obviously, we want to see that a company has enough cash to cover their at least immediate expenses and still have some kind of surplus for emergencies. And like we discussed before, there's no real magic number here that you could expect to see. Like that number really varies from company to company and industry to industry. So we generally just want to see the amount of cash increasing over time, or at least increasing as revenue and earnings are increasing. Right? And it's always good just to compare things to other competitors and similar size companies. But you also need to remember that a company may make a strategic decision to use cash, right? Maybe they want to invest in an opportunity, pay dividends to shareholders, or maybe even pay bonuses to employees. So if there's a drop in cash from period to period, you want to ask the question like, how was that cash used? Which can be answered by basically going then and reviewing the statement of cash flows that we'll discuss next. But first we want to finish the balance sheet, right? So after cash, companies then itemized other current by what we call slightly less liquid assets. So in there you see short-term investments like securities, like stocks, like bonds that will mature within 1 year. If a company has this line item on its balance sheet, it means that it has a strong enough cash position that it can invest some of that cash to generate a higher return without risking their financial security. Next in the balance sheet on the asset side, you also see that companies identify accounts receivables in there, right? Which is money due from customers who have purchased on some kind of a credit, right? So that will be on the balance sheet as well. And if you try to compare and look at the change in different periods, the change in account receivables, that can help you learn to see if the company is collecting cash faster and can use that obviously collected money and cash sooner to invest in other income producing assets or not. Then on the balance sheet again, under assets, we're also going to see inventory line item. Inventory reflects the actual cost of the inventory, such as raw materials, the labor, and the manufacturing overhead involved in creating the inventory. So in here, what you want to pay attention to is that if, let's say, inventory grows faster than its sales, like that's a potential red flag, right? Because a company shouldn't build up more inventory than it needs because it ties up cash. It also adds storage costs and overall increases the risk of creating outdated product. But then you might also think on the other hand that if there's a buildup of inventory, it could be justified if, let's say, the company, they say they're planning for a big sales push, or they say that there's an increase in demand with, let's say, new promotions or new store openings or things like that. So you always want to get the full picture, hear the full story of the company. Next in there, you also going to see prepaid expenses, which is basically the money that the company has paid to another entity, which can be considered as an assets until the products or services paid for has been fully delivered. Like for example, companies may pay their insurance premiums in January, let's say, and have the benefit of being covered for the next 6 months. So that's an asset. So if prepaid expenses and other current assets increased, then this may be due to down payment on inventory it has maybe yet to receive, or other situations like this. And overall, ideally, just as a good general rule, a company would prepay expenses as little as possible, unless it can, let's say, get a great discount, so that it overall can just keep their cash longer. So we went through kind of like all the main assets, and on the balance sheet, after all the current assets are listed, they are then totaled, right? And the total number is a good indicator of liquidity, especially when compared to current liabilities. So let's do a bit of a more deep dive now into understanding total assets. So after the total current assets line in the balance sheet will present assets that are fixed or long-term in nature. Now, what that means, it means that companies don't intend to turn those assets into cash in the next 12 months. Like a company, for example, that is sitting on more cash than it needs in the short term will look for ways to invest it for higher return through other long-term assets, right? Things like property, plant, and equipment on the balance sheet, they represent the cost of these assets, right? Then less than the total depreciation that has been booked for them. That's a bit tricky, but it's just good to know that. Another asset that you may see on some balance sheets is goodwill. Now, goodwill, it's got nothing to do with how well the company is liked or what good deeds it has done or anything like that. Goodwill, that's the difference between how much a company pays to acquire another company and the value of the acquired company's tangible assets. Bit tricky, but the goodwill accounts for the value of the intangible assets that were acquired. So when a company buys, let's say another company's, right? Much of the value, it's when they're acquiring a company, it's acquiring a specific business, right? That isn't necessarily property, plant, or equipment. but they have intangible assets. When I'm talking about intangible assets, I'm talking about the brand, the name of the company, the supplier relationships, the people who are part of the company. So that number is then being considered as a goodwill, and it stays on the book forever, basically, unless there is a reason to reduce the value. Like, for example, if all the employees left and sales dropped, the value of the acquisition would drop, right? And that would potentially be reflected in the goodwill line item. And then later, if the company will decide to later sell that company that they bought, the goodwill will be basically taken off the balance sheet as well. Another thing to go through is other assets. Other assets, that's the last asset listed on the balance sheet, and it represents the value of non-cash assets that are longer term, right? Such as like prepaid expenses, accounts receivables, notes. Now, with all the assets that are listed, you can calculate total assets, right? When you have all those assets, you can then calculate total assets. The line item, like this line item, is important because it represents the foundation of the company, right? It's basically, that's how they're building, like with those assets, it's going to help to build and support their future, the future of the company. And it's also the core component of asset strength and liquidity. So you ideally obviously want to see growth in here as well. Other than growth, when receiving the total assets number, it's very helpful to then calculate the return on assets, or ROA in short, which I mentioned before because it's really one of the most important things to calculate in a balance sheet. Reflects, I don't know if you remember, but it reflects asset utilization and organizational efficiency, because it basically tells us how much profit is generated for each dollar invested in assets. So just as a reminder, return on assets is calculated as net income divided by total assets. The average ROA for most industries is around 7%. And for software, for example, you'll see much higher numbers, maybe 13 or so. So it's just another good trend to watch for a company. Now, a company should be striving to improve its ROA over time, using its assets more and more efficiently because they want to generate with it more profit. But it's also not uncommon to see drop in ROA in companies that are focused on growth, right? Remember, we said when companies trying to grow real fast, they may invest in a number of assets to prepare for growth, but it may take time for those assets to generate the profit that they're expected. All right, next, let's talk about and dive into current liabilities. Liabilities are the obligations we have to others, right? And they are used to finance and grow operations, and are those necessarily in most companies. But at the same time, accumulating too many liabilities, especially in relation to assets or equity, can be a sign that a company is becoming maybe too leveraged or less liquid, or that profit may begin to suffer. More liabilities usually mean more interest payments as well. And interest payments impact the bottom line, the profits. Now, because liabilities are paid or settled over time, they are listed in order of those due the soonest, right? So current liabilities to those due latest, like long-term debt or mortgage or loan notes. Now, when you see that each line item in liabilities increase, it can also be due to the company's strategy for growth. So you need to, again, understand the full picture. It's not, you can't just get all the picture just with looking at the numbers and know if the business is good or not. And also you want to remember that a good cash strategy is to pay liabilities as slowly as possible without incurring penalties or damaging supplier relationships. Current liabilities, those are liabilities due to be paid within 12 months. And it's basically the total of invoices the company has in hand, but is not yet paid. This would include expenses for utilities, rents, inventory purchased, things like that. You'll also see things like income taxes payable that are basically taxes that are owed, but have not yet been paid. For example, a company paying taxes on a quarterly basis will accrue taxes for 3 months before making payment. So accrued payroll and related expenses refers to money that is owed to employees, but has not yet been paid. This doesn't mean that the company is holding on its employee paychecks. It may be related to commissions, bonuses, or benefits that are earned over time and paid at the end of the quarter or year. You'll also see other accrued liabilities, and that's the kind of like catch-all for liabilities that don't fit into the above line items, such as retirement obligations, and things like that. And remember, it's always preferable to have current liabilities to be less than current assets. That's the ideal. That's what we want to see in companies, ideally. And a critical question we want to ask when we review current liabilities is we always want to ask, like, are there enough current assets to pay for all the current liabilities here? The current ratio is next, which is one of probably the most important measures of liquidity, can help you with answering this question. So the current ratio is simply current assets divided by current liabilities. The higher the current ratio, the more liquid and secure a company is, because it's more able to pay off their current liabilities. If the current ratio is greater than 1, the company has more current assets than current liabilities. If it's less than 1, the company has more current liabilities than current assets and would be unable to pay off its current liabilities if they suddenly, let's say, came due unless they borrow money or sold an asset. So let's do a bit of a double click on total liabilities. So once we look at the current liabilities, once like current liabilities are tallied, the long-term liabilities are listed next. These are the financial obligations that extend behind 12 months. Like if the long-term debt is going up every year, we'll want to look into the equity position, compare it to, and understand if we need to raise a concern about it here. But many companies, they finance some of their growth by borrowing, right, which is a lot of companies do that. It's a good way to fund growth, especially when interest rates are low. And then you'll see many companies that will itemize their long-term debt, including items for mortgage loans, retiree benefits, long-term lease obligations, for office space, things like that, equipment or other assets, and notes or bonds issued that are due to be paid behind the 12 months. So once all liabilities are listed, they can be tallied to determine total liabilities. It's an important line item because it reflects the total debt of the company, which then can always be compared with total assets or equity. So to get some context for total liabilities, let's look at the debt ratio, which is a comparison of total liabilities to total assets. Basically, total liabilities divided by total assets. So once all liabilities are listed, they can be tallied to determine total liabilities, which is an important line item because it reflects the total debt of the company, which can then be compared with total assets or equity. To get some context for total liabilities, let's look at the debt ratio, a comparison of total liabilities to total assets, basically total liabilities divided by total assets. So let's say debt ratio has been about, let's say 0.21 for the past 2 years, which means that about 21% of its asset value is financed through debt. Now this is quite low, for example, so it's a good sign of financial strength. Many companies have debt ratios that are very high, which means that they incur a fair amount of debt to acquire their assets. So let's talk next about shareholders' equity on the balance sheet, and that will give you kind of like the full picture on things. So shareholders' equity is the third major category after assets and liabilities. It's sometimes called stockholders' equity or partners' capital if the business is privately held partnership, and is the difference between total assets and total liabilities. Now there are a few items that may be included under stockholders' equity, particularly for public companies. The first is common stock and additional paid-in capital. So when stock is first issued, it is valued at some kind of a nominal figure, a par value such as, let's say, 0.01, like 1 cent per share. And when the stock is then purchased by investors, the price is always substantially more than the par value. Then the additional amount paid by investors over the par value per share is known as the additional paid-in capital. In there, you also see the number of shares of common stock issued and outstanding. They'll be identified on the balance sheet as well. So a company can also issue more stock each year, which can increase the paid-in capital or cash generated from issuing a stock. So remember, we just discussed how equity is built in a company through issuing stock to shareholders. The other important way to build equity is through a company's profits. When a company shows a profit or loss on its income statement, this amount, less dividends distributed to shareholders, is added if it's profits, or subtracted if there are losses, to the retained earnings category on the balance sheet. And if it were not the case, assets would not balance with liabilities and equity. The profits and losses accumulate over the years in retained earnings. So retained earnings is a reflection of the accumulated profits that has that have not been paid out as dividend. And as earnings are retained in the company, the assets grow. So basically changing retained earnings from year on the balance sheet will be the exact amount of net income shown on the income statement in the last year. So if the company isn't paying a dividend, all of its net income or profit will be retained in the company and therefore increase the company's shareholder equity. Shareholders' equity is used to calculate a number of ratios. And we talked about equity ratio before, which basically measures equity as a percentage of assets. So it will be good to compare it year by year and see if it goes up or down. It will help understand if the company has a lot of equity to borrow against or not, and if it needs to raise cash. And also here, like many other things in the financial statement, the average equity ratio varies greatly by industry. Like with banks, you could see it below 10%, and with tech companies, you might see it often over 50%. Another important ratio related to shareholders' equity is the debt to equity ratio, which is calculated as total liabilities divided by shareholders' equity. So while good companies can have liabilities equal to 2 or 3 times the amount of equity, this relationship is important to consider. A higher percentage of equity or assets in relationship to liabilities means and indicates that there's a greater financial strength. The debt to equity ratio indicates how leveraged a company is, meaning how much it has relied on debt to fund its investments and therefore its growth. A high debt to equity ratio means that it has relied more heavily on debt. What that means? Well, with debt comes interest, expenses, and then more debt, the more interest you have, right? So if a company is heavily leveraged, meaning it is primarily using debt to fund its investment, its earnings may be affected over time by interest payments, which impacts the bottom line. Like if times get bad, a highly leveraged company might go under, which happened to many companies in the 2008 and 2009 situation. But at the same time, remember, debt is not a bad thing necessarily. Most companies need it to grow, and debt can be less costly than other ways of raising capital because for one, interest payments are tax deductible. They then lessen the amount of income on which a company has to pay taxes on. And of course, debt to equity ratio can vary by industry. And most companies try to kind of like be in the, let's say, 0.5 to 1.5 range. The last line you'll see on the balance sheet is total liabilities and shareholders' equity. And as you know, it always equal or balances with total assets. So what someone can do to help a company to make a positive impact on the balance sheet. You can help reduce or eliminate non-producing assets and acquire more effective assets in the future. For example, keeping inventories down without impairing sales. You can make better use of or conserve cash. You can negotiate better terms on credit and debt, and you can work to improve profitability using the assets you already have. So let's do a quick summary on insights into the balance sheet. Remember, the balance sheet measures financial strength, especially your company's liquidity and ratios of liabilities, basically debt to equity and assets. The balance sheet formula is assets equal liabilities plus equity. This financial statement, the balance sheet presents assets first, then liabilities, followed by shareholders' equity. The balance sheet must balance the amount of assets with the source of funds to acquire them. So liabilities, debt, coming from creditors, plus equity coming from the owners. The balance sheet is a financial snapshot taken at the end of the month, quarter, or a fiscal year. And key measures to look for include cash, current assets, current liabilities, and shareholders' equity. Assets are listed in the beginning with those most liquid through to those least liquid. Current assets are those that should be converted to cash within 12 months. When you take the net income from the income statement divided by the total assets on the balance sheet is a measure of your company's overall productivity, which called also return on assets, or ROA for short. Liabilities are in order of those due first through those due latest. Current liabilities are those coming due within 12 months. The current ratio, which is current assets divided by current liabilities, is a key indicator of liquidity. Shareholders' equity is equal to assets minus liabilities and is generated by shareholders investing in and profits retained by the company. The debt to equity ratio indicates how much debt is used to finance the growth of the company over a specific period of time. Now, everything you do to impact cash, profits, and assets influences your balance sheet. Next, let's talk about statement of cash flows. So remember, we began this training, this video with cash flow. and we'll end with it. That's how important cash flow is. Without strong cash flow, a company will quickly die. With it, a company can weather almost any storm. The statement of cash flows, or the cash flow statement, measures the amount of cash a company generates and uses during a particular reporting period, usually a quarter or a fiscal year. It will include where cash is coming from and where it goes. It provides important information about company's ability to generate cash, pay debt, make acquisitions, survive market conditions, invest in growth, pay dividends, buy back stock, and otherwise exercise its financial strength. While the income statement and balance sheet reveal important information about a company, you can't tell from them how much cash your company generated during the reporting period, or how much cash was generated from normal operations in contrast to investing and financing activities. Those three categories of activities, those are the categories we discussed in the beginning of this video, if you remember. Now, this information is just as important as profit or equity when you are trying to assess the health of a company and just to understand how you can help it grow. The basic equation for the statement of cash flow is cash from operating activities plus or minus cash from investing activities plus or minus cash from financing activities equal net increase or decrease in cash and equivalents. So let's do a big picture breakdown if you only had a few minutes to check it out. So if I only had a few minutes or a couple of minutes to review the statement of cash flow, you can still learn a lot about the company with following those following points. So you want to start with checking cash from operating activities. On the statement of cash flows, look for a line item that says net cash provided by operating activities. The dollar amount for this line item had better be positive, unless the company is new and maybe is spending cash to get started. For a mature company, negative cash flow is a very bad sign, and a company with negative cash flow over time is unlikely to survive. This is the most important number on the statement of cash flows. Next thing you want to check is growth in cash from operating activities. Ideally, you want the cash provided by operating activities for a company to increase year over year. You want to see it increase because it means that the core business is generating more cash as the company grows. Operations are becoming more efficient, and overall leaders have just better understanding of what's going on. And then what resources they need and when to continue and grow the business. But at the same time, you need to remember that there could always be a potentially even a good reason on why the number would decline from one period to next. So you need to know the full picture. So when cash generated goes down or up, especially if it's significantly from one period to the next, it's a red flag that you need to help you with asking questions, right? You want to ask why, what happened? Next thing you want to check is cash used in or provided by investing activities. In here, you actually prefer to see a negative number because it indicates that a company is investing in assets. And investing in assets is important in order to both maintain existing assets and to acquire new assets needed to support growth. Next to check is cash provided by or used in financing activities. A positive number for this line item means that the company is borrowing money or issuing stock. A negative number means that the company is using cash to reduce debt and or provide value to shareholders. So those pretty much would be the things that I would check if I only had a few minutes. Now let's me talk about perhaps what I would do if I had more time to spend on the statement of cash flows. So remember, the cash flow statement, the entries show cash flowing in and out of the business for operating, investing, and financing activities. The total amount of cash generated from all those activities, right? And overall the cash position. When you see positive numbers, it means that the source of cash for the business, and negative numbers, it means that the cash used by the business. And in here, remember that the negative numbers do not mean a loss. It just means that the cash was used for a certain purpose rather than received. And that's why for this reason, some finance people will refer to this statement as a sources and uses of cash statement. The cash flow statement includes numbers from 3 most recent reporting periods, making it easy to see different changes and trends. The most important items on this financial report are those. First, net cash provided or used by operating activities. Next, we want to look at net cash provided or used by investing activities. Also, net cash provided or used by financing activities. And the last one is net change in cash and cash equivalents. So let's dive a bit into each of those to explore how the numbers reveal important details about the business. Starting with net cash provided or used by operating activities. So a review of a cash flow statement always begins with determining cash flow from operations, because cash generated from normal business operations, specifically related to the sale of its products or services, is just the most important sources of cash. To reach the calculation of cash flow from operations, the statement of cash flows begins with net income and make adjustments to show how cash flowed into and out of the business. You'll then notice that the first line of a company's statement of cash flows is the bottom line from the income statement, right? And both have the same label, net income. For any large organization, net income is an accrual-based number, meaning that it's based on the revenues and expenses booked or recorded in particular period as a result of sales in that period. Now, the company may receive cash from that booked revenue or use cash to pay those booked expenses in different period. So net income isn't an accurate measure of cash flow. Remember that. It's very important to remember that profit and cash flow are not the same thing, right? Because financial statements are based on what we call accrual-based accounting. So the statement of cash flows begins with an accrual-based calculation of the net income. However, because the statement of cash flow is trying to determine actual cash flow from operations, cash actually received or disbursed, not booked, it must make adjustments to net income to get an accurate amount. So that's why the first adjustment you'll see to net income is usually depreciation and amortization. And as a positive adjustment to net income. Why? You'll notice on the income statement that this same amount entitles depreciation and amortization is an expense which reflects the decrease in value of certain assets over time. But this is a non-cash expense. The company don't really pay someone the depreciation. Therefore, it is added back to the net income on the statement of cash flows because this expense didn't require the use of any cash. Right after depreciation and amortization is a group of line items that will be labeled as change in operating assets and liabilities. These adjustments, they show changes year over year in some of the balance sheet accounts that may use to generate cash. I'm talking about things like accounts receivables that reflects the reality that cash was generated or lost by reducing or increasing receivables from the prior year. Same goes with inventories. Was the cash spent to increase or decrease inventories? The accounts payable amount will then also be there to reflect the fact that in the growing business, the business funded part of its growth by buying items on credit. Then you'll see income taxes payable, which indicates if income taxes have increased or decreased by this amount, but perhaps have not been paid, then it will be a source of cash as well. Same applies with accrued payroll and related expenses and other accrued liabilities. If you see the amount of those increased from year to year, it means that the business still has the use of the cash, so they are reflected on the statement of cash flows as a source of cash. At the end of it, you'll see usually a summary entry of net cash provided by operating activities, which is calculated by adding the positive cash in and negative cash out numbers. So the net amount flowing into or out of the business is the total, right? This is the most important number of the sheet. As we said, unless the company is very young, this number had better be positive. And of course, you'll always want to look at trends from year to year, and you'll always want to know why cash has decreased, if that's the case in a business. The most important ratio to analyze here is the amount of cash flow generated from operating activities compared to profit net income for the same period. To calculate it, it's really easy. We should divide the cash from operations by net income. And you generally want this ratio to exceed 1, meaning that you want cash flow to be greater than profit. Why? Because it reflects a company's ability to effectively turn profits into cash. Now remember that a sale doesn't generate cash until it is collected. The ratio can go down over time because of the growth efforts, but the company always wants to watch the trend carefully. Next, let's quickly discuss cash provided or used by investing activities. So after operating activities, the statement will reveal cash flows from investing activities. Unlike cash flow from operations, which should be positive, healthy companies frequently use cash in investing activities. And it's very typical to see negative numbers, and it simply means that management taking cash generated from operations or financing activities and invest more cash in assets. When you review competitors' cash flow statements, take note on who's investing cash, who's buying assets, or even acquiring other companies to support future growth. So if you see a company that is growing well this year, but they're not investing in their future growth, they will likely see a growth slowing over time. If you see a company with a positive amount here, maybe they would be selling assets to generate cash, which is not sustainable long term. Like for example, you can see a company that could sell off one of their stores to try and generate cash, but would then have one less store to bring more cash flow in the future. And if that company continue this strategy, they might end up with a lot of cash, but not stores and no retail business eventually. Next, let's talk about cash provided or used by financing activities. So finally, in the end of the cash flow statement, you're going to see the cash in and cash out from financing activities. This section reveals how a company is financing its business. Many times they might issue stock to generate cash. It can also increase their long-term debt, basically borrowing more cash. If the company repay their debt, it would be seen as a negative number because cash would be used to reduce debt. If the company is public, this section will show whether a company is paying a dividend or buying back stocks. Now, there are strategies the company uses to leverage their excess cash and provide value to different stockholders. For example, dividend payments, they offer value in a very direct way, and a stock buyback makes the remaining shares worth more money, because fewer shares mean that each share is tied to a greater percentage of the company's earnings, those raising overall the stock price usually. Understanding how the competition is funding its business or using excess cash is also super useful to always check different companies similar to this one. You want to check, are competing businesses, are they borrowing money? Are they issuing or buying back stock? Are they paying a dividend? These are super important questions to consider as you dive into the company's financing strategies. Next, in the statement of cash flow, you'll also see what we call net change in cash and cash equivalents. Towards the bottom of the statement of cash flow, you'll also see increase in cash and cash equivalents or decrease. So it's always just good to remember the basic equation for this statement, right? It all adds together the net increase or decrease in cash for those three categories that we went through, right? So what is it? Net cash from operations plus investing plus financing equal increase or decrease in cash or cash equivalents. Of the three categories, cash provided from operations is the best way to generate cash. Remember, this reflects how the company's core operations is doing. Because in the end of the day, in any business, generating money by just selling investments or assets is not sustainable. If cash generated through borrowing, the company will have to pay for it eventually, right? With interest. That's why I want to quickly discuss cash and cash equivalents at the end of the year. It's important to know that the net change in cash is the amount added to or subtracted from the cash and cash equivalents at the beginning of the year to create the cash and cash equivalents at the end of the year. Right? I'll repeat that. The net change in cash is the amount added to or subtracted from the cash and cash equivalents at the beginning of the year to create the cash and cash equivalents at the end of the year, which will basically be the last line item on the statement of cash flows and the first line item on the balance sheet. Remember that. So overall, the statement of cash flows tells the story of how the company is ending up with a certain amount of cash in the bank, and you could see if the number has been increasing each year or decreasing. Also, it's good to remember that there might be a reason why a healthcare company would have a reduction in cash balances in 1 year compared to, let's say, the prior year. Right? The statement of cash flows would give you clues on exactly why this happened. The statement of cash flows helps us understand how a company is balancing its needs to retain cash with its needs to use cash to grow the business. It reveals how cash was used to further strategies that might change from year to year, just as the focus on particular drivers might shift over time. So let's do a bit of a recap on the statement of cash flow. The statement of cash flows measure cash generation. The statement of cash flow, or the cash flow statement basic equation, is cash from or used in operating activities plus cash from or used in investing activities plus cash from or used in financing activities equal net change in cash, right? So the three primary sources uses of cash include operating activities, investing activities, and financing activities. The cash flow statement begins with net income from the income statement, remember, and makes adjustments to calculate cash flow. Then it ends with the cash and cash equivalents, which is where the balance sheet begins. You always want to see cash from operations, the most important number on the page, to increase each year, right? Cash balances might not increase because of other strategic uses of the cash. Everything impacting profit and uses of cash also influences your cash flow statement, such as expense reduction and sales increase. I'll just add and say as a final note that if you're looking at a private company and don't have access to the cash flow statement, you can build it on your own using the income statement and balance sheet. It's behind the scope of this training, but worth looking into and searching the process if it's needed in your case. All right, so you've learned a bit about how a company functions and how to tell whether it's successfully growing and generating profits. What do you do now? What I've provided here is the foundation, a foundation you can turn into deep knowledge about how your company operates now and should operate in the future. You now have the tools to add value and understand or influence decisions in any organization. I hope you enjoyed it and received some value today. If you did, I'd appreciate if you comment on your thoughts and perhaps suggest topics for more videos like this where I could do a deep dive on specific topics. Also, share it with your friends or someone who could potentially benefit from it as well. In addition to that, if you'd like to receive a PDF with all the key terms and ratios that we discussed on today, reach out to us or comment below with your details and we'll get it to you. Or we might put some details below this video. Either way, I hope you enjoyed it and take care and goodbye.